Happy evening to all the members virtually present here. On behalf of SIRC of ICAI, we welcome you all to today's session on Ind As 115, that is revenue from contracts with customers, which is very relevant to consider whether an entity shall consider the terms of contract and all relevant facts and circumstances when applying for accounting, and also to report useful information for users of financial statements about the nature, amount, timing, and uncertainty of the revenues and cash flows arising from contract with customers. So to throw a light on this subject, we have with us an eminent speaker who is none other than CA Naga Durga Sudhakar from Hyderabad. So, sir, we welcome you, sir, to this session. Before handing over the session to our speaker, I would like to briefly introduce him. He has a rich experience, 16 years plus rich experience in accounting and auditing, and he's presently serving as a partner in NSVR and Associates LLP. And before that, he had vast experience in corporate sector, and that too, as he worked as a director finance at Dr. Reddy Laboratories Limited, and he played a role as an analysis of complex accounting transactions from IFRS and Ind As point of view, and ensure their appropriate accounting and disclosures. And he served as a senior lead manager in Bharat Financials Inclusions Private Limited, and he served as an assistant manager in BSR and Co Hyderabad. Apart from this, he is a resource faculty for ICAI in importing training as a part of Ind As training program, that is a certification course, and he is also a technical reviewer in FRRB board of ICAI. He is a resource faculty for Indian Audit and Accounting Services at Hyderabad, and he is also authored a book, Impact on Ind As on Pharmaceutical Industry. With this very brief introduction, I once again wholeheartedly welcome you to this session, sir. Now I hand over the session to the speaker, CA Naga Durga Sudhakar, sir. Over to you, sir.
Thank you. Yeah, is my presentation visible?
Yes, sir.
It's not in a presentation mode. Yeah, but yeah, okay. So good evening, everyone. First of all, thanks a lot for the opportunity. I really enjoy the sessions, technical sessions, whatever that opportunity that is being given to me, either by Hyderabad branch or by the SIRC. Because I kind of like or little passionate towards explaining the concepts to the extent I have known or I have learned. So with that, yeah, because anyways it's now 4 minutes past 7, 5 o'clock. Given the paucity of the time and the topic that is being assigned to me, rather than saying assigned to me, I would say that is being selected by me, because when once first SIRC approached me, can you take the session on accounting issues in pharmaceutical industry, I myself have said, can I take another session instead of the same pharmaceutical industry issues and all such, because I've already taken twice. So in a way, I am the person to be blamed of. In fact, if at all somebody was looking up to, okay, if this revenue standard is little more important and we need a thorough person to take up this particular session, yeah. With that, yeah. Those who already know me, it is the same boring face and the boring profile. Those who don't know me, maybe you can very well be able to, guess the prowess of my speaking by the end of the session, kind of stuff. Yeah. So with that, we will start the topic that is meant for today: revenue from contracts. With the customers, basically. So with that, let's directly jump into the topic. So I am now putting the presentation in the presentation mode. When once I shift it to it, I will not be able to see any screen or anybody. I'll not be able to see the comments as well. I'll only be literally, in a way, talking to myself by looking at the presentation. So the manner in which I have designed the whole next 3 hours would be predominantly I will be taking over, the talking part of it almost for 2.5 hours to 2 hours 45 minutes. Then I will give some time, and in the last 15 minutes or 20 minutes, probably we can discuss on whatever the queries you have. So I would request the participants to make a note of any point that has missed out in terms of me articulating, or where you have understood it in a different way, or any doubts you have, or any clarifications needed. Then probably we can touch base it at the end of the end of the session, where the question and answer session gets opened up. Next, yeah, I'll just get into the presentation mode. Yeah. Now, revenue from contracts with customers, Ind As 115. Most of you know that the parent accounting standard for this Indian accounting standard 115 is nothing but IFRS 15. So it's predominantly, almost I would say, it's aligned to what the content that has been given in the parent accounting standard IFRS 15. Now, what is so peculiar, or what is so interesting with respect to the revenue recognition standard written by International Accounting Standards Board? If you see, of course, we are very much aware that there are two notable accounting standard setting bodies. One is there in United States, one is there in UK, in the name of Financial Accounting Standards Board, and one in the name of International Accounting Standards Board. One is called colloquially US GAAP, and another one is called IFRS. And we all know that there is a significant difference in the principles of recognition when it comes to various accounting concepts. And they also have endeavored to bring out or minimize these differences by embarking themselves on some convergence, in a way, basically the convergence project kind of a thing, so that they will minimize the principles of recognition or various accounting concepts between US GAAP and IFRS. So while the convergence, the task or the project has started to an extent little 5-6 years back, probably in the IFRS 15, or so to say ASC 606 in the United States GAAP, can be considered as a single accounting standard that has been written by both the accounting boards together and has been released to the world. At least to start with, when the accounting standard was first implemented or introduced, it was a single accounting standard in the whole world when it comes to revenue. But later on, both the boards have their own differences when it comes to interpreting the provisions that have incorporated. The way US GAAP looked at some of the aspects and the way IISB has looked at some of the aspects is different again. So again, so to say, even though it is a single accounting standard, after the implementation, the post-implementation review has resulted in some of the different approaches taken with respect to some of the stances or some of the provisions in the accounting standard. So one interesting thing is, yeah, it is definitely a major step towards convergence of the whole accounting standards into one, when the economics can be one and the same for the whole world, physics can be one and the same for the whole world. Why can't accounting be one and the same for the whole world? Yeah, but still there is a significant amount of task that is still left over because of various perceptions and the way a particular transaction has been looked into. The topic is, when once we say, yeah, now we will be predominantly, obviously, when once we get into IFRS 15, subsequently it has moved into Ind As 115. We have another 3 hours or so or kind of time for this entire accounting standard basically to be understood, or to be basically to have a grasp of, One basic disclaimer before the start of the session is any examples or any views that I have taken are purely my personal views in the capacity of Naga, Durga, Sudhakar, and they do not resonate or reflect any of the views of the institute. Second, purposefully, I have included some of the examples which are verbatim picked up from International Financial Reporting Board standard. Whenever those kind of examples are replicated, the speaker or the person who has used that particular example has to mandatorily use one quote that this is property of IFRS or IASB, and so please use, the discretion is needed whenever subsequently people are using it. So in my slides, whenever those examples have been picked up verbatim from that particular standard, you will see that particular cautionary statement. So don't think that it is actually an IFRS copied and pasted kind of a statement. I need to mandatorily carry that kind of a remark or that kind of a caution. That's the reason why I'm including it. Second, one of the, I would say, lengthy accounting standards that so far was written in International Financial Reporting Standards or Indian Accounting Standard is revenue. Let's not get into the thoughts like complex accounting standard or it is tough, it is very complicated accounting standard. I don't endorse the views of complexity and complicated. If I can read and I can understand and I can go to a level of speaking on this particular accounting standard, anybody can do. Only thing is, certain subtle nuances of the accounting standard are little difficult to be understood or comprehended within 3 hours of time. So those who have already have a fair view of accounting standard with respect to revenue, maybe can be able to grasp some of the examples, or maybe they will be able to revise the whole accounting standard as I speak. Those who are reading this particular accounting standard for the first time, they might need some more amount of time to understand some of the aspects that have been introduced by this particular accounting standard. So with that kind of a disclaimer, I would now jump into this particular accounting standard. As I said, the Ind As 115 revenue from contracts with customers is basically, as I said, it's one of the lengthy accounting standards with almost 129 paragraphs. And very interestingly, you won't believe, when IFRS 15 was written, IFRS 15 has some illustrative examples accompanying this particular accounting standard. And you won't believe the number of examples that were given by the standard setter for this recognition standard is 64 examples. I repeat, 64 examples were given for this particular concept by the standard setter himself to let the reader understand the concept in a much better way. So you can understand 129 paragraphs, 64 examples, basis for conclusions, how lengthy this particular accounting standard would be and how much time consuming it would be if one were to start it now. That's okay. Even if you start it now, maybe in 5-6 months of time, if you read it on a regular basis, probably you'll be able to get a decent grip over this particular accounting standard. Now, from when this particular accounting standard is effective? In India, it's effective from 1st April 2018. And with whenever any new accounting standard is introduced, obviously it has, that retrospective application is needed as per Ind As side. But of course, there are certain relaxations that have been given for some of the accounting standards, whether it has to be a full retrospective application or a modified retrospective application. We will see a line about that, effective date and transition, as the slides progress. Yes, now Ind As 115 supersedes Ind As 11, Ind As 18, and there is one guidance note for real estate transactions. All these 3 guidances were replaced by Ind As 115. So earlier we had one exclusive accounting standard for construction contracts. We have one exclusive accounting standard for other than construction contracts, which is a general guidance on revenue, and a specific guidance on real estate transactions. So all these 3 have been now replaced by Ind As 115. What does it mean? every accounting transaction with the customer has to be evaluated using the principles of Ind As 115. Even the service concession arrangements were made part of this particular accounting standard itself. Let me be very honest, I am not going to cover service concession arrangements in this particular accounting standard, in this session, given the paucity of time. I generally wanted to speak over the entire recognition principles, measurement principles, and the entire accounting standard as such in the next, whatever the time that has been allocated to us. Okay, now moving on. What is the reason or what way, in what particular way this Ind As 115 is more superior when it comes to its erstwhile gap of Ind As 11 or Ind As 18? Frankly speaking, the guidance with respect to certain aspects like cost of warranties, allowance for sales returns, and the concept of multiple deliverables, all these were not so detailed, in a detailed way explained in the erstwhile gap. All these concepts are now very explained in a very, very detailed way as far as the Ind As 115 is concerned. Frankly speaking, it makes a better sense for those who have followed IFRS, those who can actually relate it to IAS 18 and IAS 11 well. But as and when the particular Indian accounting standard project has been started in India, immediately I would say Ind As 115 has come into picture. So not much time is left for the people to clearly understand what is there in Ind As 18. Rather, immediately people have changed in a year and a half actually from Ind As 18 to Ind As 115. So when you compare from what was the so-called previous to previous gap, AS 9 to Ind As 118, it's a I would say sea change. Significant difference when it comes to AS 9 to Ind As 118. There is nothing called revenue recognition principles addressed separately for sale of goods, rendering of services, and for construction contracts or use of enterprises assets by somebody else. So there is no different accounting principles for product sale, service income, and license fee kind of a thing. Whatever may be the transaction, whatever may be the nature of transaction with the customer, be it service, be it license, be it product sale, or be it construction contract, real estate, infrastructure, anything, it has to be evaluated under the principles of Ind As 115. Now, consideration paid back to customer, one of the most important concepts and the most, probably in a way, in international world, probably in a developed world, the most abused concept. How these particular provisions were there previously and how they have been addressed now in this accounting standard. We all get to know and deal with it very, to an extent in a detailed way. And concept of constructive obligation in the sales contracts. I think I need not explain you, from the scratch what exactly a constructive obligation is. We all very much know IAS 37 provisions, contingencies and contingent liabilities introduces us to the concept of constructive obligation by a cross reference to Ind As 19 employee benefits. So when there is a reasonable expectation in the minds of the recipient that the entity would do certain act, obviously an obligation arises in the books of the entity. Similarly, the concept of constructive obligation has also been incorporated in the revenue accounting standard. What does it mean? When the company tries to state its obligations as per the contract, sometimes all the obligations need not be explicit or need not be agreed upon in the contract. Sometimes, because of the past practices of an entity, it might create a reasonable expectation in the mind of the customer that entity would end up doing this service to me despite its non-existence in the contract creates an obligation. We'll get to see all these matters in detail when once we progress in the topic. Okay, now a brief overview of Ind As 115. As we said, the literature has significantly moved when it comes to AS 9 and significantly moved even when it comes to Ind AS 18 concept. Now there is a single accounting standard for construction as well as non-construction type of transactions. The most important characteristic feature of Ind AS 115 is it moved away from risk and reward approach to, it has moved now to control approach. What do you mean by moving away from risk reward approach to control approach? Earlier we have seen that whenever we are evaluating the transaction of revenue, it has been, for years altogether, it has been trained, our minds have been trained in such a way to think about whether the company has transferred all the risks and rewards or not. Now, there is no such question. There is no evaluation of whether the risks and rewards. I mean, it is not specifically viewed from risks and reward angle. It is more so viewed from control angle. Here, I just want to pause and bring one particular aspect in Indian accounting standards. If you see, the entire Indian accounting standards are slowly moving towards, in a way, I would rather say not moving towards, I think they have significantly moved. When it comes to recognition aspects, it is more of a control aspect. When it comes to measurement aspect, it is more of a fair value. So to say, I can say that the pillars of, Ind AS are, when it comes to recognition, it is control. When it comes to measurement, it is fair value. Let me try to articulate better. How is inventory recognized, or when is inventory recognized? IAS 2 harps on saying that inventory is recognized when the entity obtains control over the inventory it bought. Property, plant and equipment is recognized in the books when the entity obtains control over the particular item of property, plant and equipment. When these are de-recognized, when the entity loses control, they are de-recognized. Same is the case with intangible assets. Same is the case with acquisition of interest in another entity. When an entity is consolidated when the investor obtains control over the investing. When the entity does the business combination accounting, when an acquirer obtains control over the business of the acquirer. See how uniform the principles of Ind AS are when it comes to recognition and derecognition. Everything is control driven. Similarly, the risks and rewards approach under Ind AS 18 has been replaced with the control approach for Ind AS 115, meaning entity will recognize the revenue when it transfers the control to its customer. So whether it has retained one particular type of risk or a particular reward has not yet been transferred to the other party, it is not that is relevant, but rather what is more relevant is who is more in a way authority to take decisions with respect to whatever the item that is under consideration, say with respect to delivery of goods or with respect to a service component. Who is more authoritative when it comes to decision making? In a way, I'm purely putting it in a layman terms, but the manner of evaluating what has been transferred from one party to another party is not risk and reward. It is more of a control angle. So whether the customer has obtained control from the seller or not is the most relevant thing. Rather, in fact, I have said it in a little different way. The most appropriate way to say is whether the seller has transferred the control or not. In a very, very aggressive way, if I were to put it, whether the customer has taken the control or not is also not relevant. What is more relevant is whether I have passed on my baton from my hands or not. In a relay running race, you see runners exchanging the baton. Like that, whether the seller has transferred the baton or not, whether the relay runner holds it or in a way loses it, it's of no matter for me, I will stop running. Similarly, I have transferred my control, irrespective of the fact whether the customer has owned that control or not, I will start recognizing the revenue. That's the reason why the concept of recognizing revenue in case of CI of contract and all the discussion has come into picture, whether revenue can be recognized little ahead of what used to be the principle under international Incoterms kind of a position. Now, as I said, it moved from a risk and reward approach to control approach, and the manner in which the evaluation of the transaction happens in Ind As 115 is in a 5-step model. All the 5 steps are in a way a logically stated method process. Step 1 is identify the contract with the customer. Step 2, identify the performance obligations and then determine the transaction price, allocate the consideration and recognize the revenue. In the slide, I have given in brackets the paragraph numbers. Whatever that you could see in the slide after that particular step is paragraph numbers. Why did I give these paragraph numbers? Just to explain, I don't know how many of you have actually gone through the bare accounting standard of revenue. Any accounting standard, be it in Ind As or be it IFRS, it follows a particular methodology. First, it starts with objective, then it says what is the scope, then it explains definitions, then it explains recognition principles, then it explains measurement, then presentation and disclosure. Even this particular accounting standard was written when it comes to bare accounting standard following the same principles. But the 5-step approach and the normal approach of writing the accounting standard do not coincide. Just to explain you, see, step 1 is paragraph 9 to 21, good. Step 2 is 22 to 30, fine. Step 1 and step 2 have a flow even when it comes to bare accounting standard. But see the step 3, determine the transaction price, which is basically a measurement aspect, is coming from 47 to 72. That means after step 2, where is 31 paragraph? It is there in step 5. So when you read the accounting standard as such, the bare accounting standard, after step 1, step 2, you will read step 5. So those who are reading the bare accounting standard, I would say please be more vigilant with respect to what concept you are reading. It tends to confuse you for the first 2-3 times when you are reading. That said, if you have number of readings and if you go through number of times when you can read the accounting standard, obviously the entire confusion can get you can avoid that kind of a confusion. So that's the only point here I just wanted to make you. If you are going through the bare accounting standard, just make sure that the references that are given in step 5 have properly been adhered to when you are reading step 3 and step 4 later. Okay, yeah. Very briefly, I will touch upon effective date and transition. As I said, in India, Ind As 115 is applicable from 1st April 2018. Whenever any new accounting standard is applicable, as a principle, Ind As 8 suggests there needs to be a retrospective application. But given the effort that is needed for various entities in order to adhere to the principles of certain accounting standards, so to say, even Ind As 109 had similar principles, Ind As 116 had similar principles, and even Ind As 115 had similar principles. There is some leeway that has been given to this retrospective application. What they suggested is there are 2 ways of applying a new accounting standard when it comes to Ind As 115. One is a full retrospective application if you have energy, bandwidth, and all the ability to go for all the previous periods presented. If you go back and restate the previous information, please go ahead and do the restatement, and it is called full retrospective approach. And a midway is basically the second methodology which has been prescribed is a modified retrospective approach, meaning apple is compared with orange, so to say. My previous period, say for example 2016-17, and when it comes to 17-18, or so to say, because from 1st April 2018, I will be preparing the financials comparative for 17-18 kind of a thing. So 17-18 can be under Ind As 18, or so to say AS 9 if you are applying this particular accounting standard from first from April 2018, and once you have converged into Ind As then, and my 18-19 onwards it can be under Ind As 115. So comparison looks little awkward, but that's okay. The standard setter is fine with it, because logically there is no point and no merit going back to the period and changing the revenue for which the money has also been received by the entity. I have not only recognized the transaction, I have also received the money from the customer. Then what is the point in actually going back and saying I did not earn so much of revenue, but I have only earned so and so money? I'm not, at the end of the day, I've received the money also. So in a way, that's the reason why they said when you are going for any new implementation of Ind As 115, make sure that you can actually go for a full retrospective application, or you can actually opt for modified retrospective application. Yeah. So it's just diagrammatically I have picked up this particular picture. When you do it for 2018, what is there in fully blue is basically the first period of presenting financial information or more so revenue information in Ind As 118, Ind As 115, and the comparative when it comes to Ind As 115, if it is blue, means basically I have gone for a full retrospective application. If I have gone with full retrospective with certain practical experience, it will be mixed. The third section basically is where I will be literally comparing Ind As 11 and 18 with Ind As 115. Does it make any sense when it comes to comparison? Frankly speaking, the reviewer is the viewer or the reader of the financial statement is also not much bothered, because he knows so much amount of money has already been received by the entity or has actually been provided if the money has not been received by that entity, kind of a thing. So it doesn't make much sense by dilly-dallying over the revenue that has already been recognized and received. Yeah, now the scope part. As I said, because the time is only limited here, because I need to stop at 8 o'clock, I will not be spending completely in a detailed way when it comes to each and every prescription in the particular accounting standard. As I said, the standard is little laborious and lengthy. That said, I will introduce you to the concept. It is up to you after this particular thing to take it on from them, and whatever the doubts you have, you are always free to ask me. So coming back to the scope paragraph of this particular accounting standard, to what all transactions this particular revenue recognition standard is applicable. If you remember the definition of revenue under the old accounting standard, it says gross, in a way, the emoluments received by the entity in an ordinary course of transaction. So the old revenue accounting standard harps more on the ordinary nature of the transactions when it tries to explain whether a particular transaction comes under revenue transaction or not. No such definition that has been given here. They just said only one thing. Any contract that has been entered with a customer will be a contract that has to be evaluated under Ind As 115. So for us, the starting point is to identify if you have entered into a particular contract with any party. The first and foremost responsibility of the entity is to identify what is the status of that other party in this particular transaction. By any chance, is he becoming a customer in this whole transaction? So the standard defined who or when a particular party will become customer. So the customer word has been defined, which we will see in the next slide. So any transaction with customer has to be evaluated under Ind As 115, subject to the following transactions. Means the following transactions need not be evaluated under Ind As 115 because they have been excluded from the scope. What are those transactions? First and foremost, leases, because Ind As 116 specifically addresses, and even in Ind As 116, especially when it comes to, although there is no difference between operating lease and finance lease from a lessee point of view, from a lessor's point of view, who is nothing but a seller and to whom lessee is a customer. In case of a finance lease, it is the same customer and vendor relationship it will have. So even though the lessee is a customer for lessor, in case of a finance lease, the transaction should not be evaluated under Ind As 115 despite being the fact that the other party is a customer, but rather it has to be evaluated under leasing contracts. Next one is insurance contracts. Why would somebody get confused between an insurance contract and a revenue contract? Because not in all circumstances the transactions carried out by the seller are the promises that are given by the seller to the customer are in the nature of vendor and customer. I'll give you one small example which I've picked up from one of the advertisements I've seen in the TV. If you remember, I think 5 or 6 years back, there was one advertisement for Samsung mobile where two people meet in a particular function and they bang on to each other and both the mobiles fall and one person's screen gets in a way destroyed. The other person gets up and when they pick up both the mobiles, one person asks the other guy, "Oh, you have the screen got destroyed. Is Samsung AK?" He says no. Then he gives a different kind of a look and then he passes on. Then the advertisement gets concluded by saying that Samsung replaces the first screen damage and basically it will be done at a free of cost. One argument that can be taken in this kind of services, similar example that can be taken is even in case of automobile industry, where one wants these roadside services. I will provide these roadside services to you, have an element of insurance that have been provided by the vendor to the customer. So the changing of the screen and roadside assistance that is being provided by the automobile seller, they are not actually the services that are to be rendered by a product seller to his consumer, because they go with, frankly speaking, warranty is also a kind of an insurance. But because it was taken out and was addressed specifically, we don't deal with under insurance provisions. Similarly, there are various promises that can be made by a business entity to its customers, which might fall in the nature of an insurance contract. There, the accounting standard states if ABC characteristic features are there in that particular transaction, maybe you need to evaluate the transaction under Ind As 117 or whatever that under Ind As 115, depending on what attributes that particular transaction has. I'm not going to elaborate this particular topic much, and we will go to the next one: financial instruments and other contractual rights and obligations. The moment financial instruments that come into our mind, we'll be thinking basically again the same question comes into our picture. How come financial instruments and transactions with customer can be in a way be confused by the reader kind of stuff? Don't think a normal transaction, think of it from the transactions executed by the financial services sector. My credit card fee. As a holder of the credit card, am I a customer for the company, or as a person who has indebted to the bank for so much amount of money? By swiping the credit card, I am indebted to the bank by so much amount of money. Now, am I a borrower who comes or who becomes a financial asset to the bank for which Ind As 109 needs to be applied, or am I a holder of credit card, which is nothing but an ordinary activity of the bank for providing services to its customer? Am I a person who is a customer to the bank where the credit card fee has to be evaluated under Ind As 115? So don't think that I'm talking about debt transactions or I'm talking about issuance of equity transactions when it comes to financial instruments. Financial instruments go back to as simple as a trader-creditor relationship as well. So what is the relationship between banker and a credit card holder? Am I a customer or am I a debtor to the bank where my relationship with the banker has to be evaluated under Ind As 109? So there is some guidance that has been given. If that particular thing is applicable, the transaction falls squarely under Ind As 109. You need not evaluate the transaction under Ind As 115. You need not break your head. Next one is non-monetary exchanges between the entities in the same line of business to facilitate sales to the customers or potential customers. If the see very clearly what is the language that has been used: non-monetary exchanges between the entities in the same line of business to facilitate the sales. That means if the customer and vendor are not in the same line of business, I'm actually a telecommunication company and you are an electricity generator, I am exchanging my units of uptime with so many units of electricity, we are fine. Both of us can recognize revenue using a fair value approach. But both of us are in the same telecommunication industry, or so to say, let's take an example of, both of us are in the explorative industry where I will exchange the natural gas in India with the natural gas in Ukraine or Russia. Both of us, non-monetary exchange between the entities in the same line of business is excluded. Why? The world has seen significant amount of round tripping transactions with respect to these kind of way of doing things. It is much easier said than done. I can very easily say this is out of revenue transaction. But imagine how on earth a person would be able to know whatever the exchange of natural gas that the company has done in India can have some correlation with whatever the exchange of natural gas it has done with elsewhere, with any other country elsewhere in the world. Obviously, it is not easy to identify these kind of round tripping transactions. But yes, as such, the standard setter has given a guidance to the companies that, boss, if you are indulging in these kind of round tripping transactions, these are more like stock exchanging transactions only. No revenue can be recognized either by you or by the buyer, because you keep on buying and selling and you keep on increasing the top line only to make the readers or the investors fools. So to avoid the round tripping transactions, they have said that non-monetary exchanges in the same line of business are excluded from evaluation of Ind As 115. What do you mean by that? They are not revenue transactions. It does not mean they are not accounted for in the books. They are not accounted for as revenue in the books. Now, very, very interesting change because of introduction of Ind As 115. There are certain consequential amendments to two accounting standards, Ind As 16, Ind As 38, property, plant and equipment and intangible assets. In what way, how come, or how on earth a property, plant and equipment accounting standard and an intangible accounting standard has to be modified when a revenue accounting standard comes into picture? I'll give you a small example. Say, for example, I have sold a plant, and along with the sale of plant, I also have said that I will continue to supply a particular product to you till the time you establish yourself by bringing business from somebody else. Or say, for example, I did some either purchase transaction or sale transaction with the other party. Now, what the accounting standard previously used to say, Ind As 16 or Ind As 38, they were agnostic of these kind of additional arrangements that the company had. So to say, if the company has transferred the control on the property, plant and equipment, now we are going to de-recognize it and recognize the amount of gain or loss on the property, plant and equipment sale. What they are now saying is, when it comes to this particular de-recognition of property, plant and equipment or intangible is concerned, there are certain, like how revenue recognition, accounting standard introduces variable consideration. Look at the variable consideration part that might come to you when you are selling a property, plant and equipment. Say, for example, I sold one plant to them. Based on the performance of the plant, after 1 year, I will get some extra money. Using the principles of variable consideration under Ind As 115, Ind As 16 asks the entities to compute the amount of sale consideration. So sale consideration is not just the amount that is received by the entity or agreed upon by the entity by signing the property sale transaction, but rather needs to be considered considering the variable consideration principles, if any, are incorporated in property sale as well as intangible assets. So only the measurement aspect of Ind As 16 and Ind As 38 have been amended. It's not that the date of de-recognition of property, plant and equipment will get deferred or kind of stuff. It's not about de-recognition of property, plant and equipment or intangible. It is about measurement of consideration for property, plant and equipment and intangibles. So anybody who has these kind of transactions where upon sale of intangibles and property, plant and equipment, you have some future consideration that might flow based on the usage of that particular plant, please be wary of the consequences of the change to these standards because of Ind As 115. Yeah, now coming back to the topic. So we said this particular standard is applicable to all the contracts executed by the company with customer. Now there is a need for the accounting standard to define who is basically a customer. Customer is defined by the accounting standard. One slight, probably I would say disclaimer kind of, not disclaimer, suggestion is, my presentations generally are studded with content. So whenever any slide appears on the screen, it generally defies the etiquette of presentation. I would rather be shameless in saying that it will have lot of content. So don't bother by reading so much amount of content when the presentation slide is on. You can kind of trust me for the next 2.5 hours. Listen to what I am saying, because these slides are only directional purposes for me. I will explain the content, what is there in the slide. You can later on use this particular presentation when you are revising basically this particular concept, or later on reading after a few months time. That's the reason why, although it does not meet whatever the principles of presentation, okay, presentation should have limited content, I generally put lot of content so that the reader can read the whole position at a later point in time, at a particular time. So that's the reason why. So don't, the moment any slide comes in, don't start reading whatever that is there in the slide. You can kind of trust me and listen to me for the time being. Now coming back, who is a customer? Customer is defined in the accounting standard as anybody who has contracted with the entity to obtain goods or services that are ordinary activities. So rather than using this word in defining the revenue, the accounting standard has used the word ordinary activities of an entity while defining the customer. So a customer of a apparel industry is anybody who asks an entity for an apparel, not medicine. Similarly, a customer for a pharmaceutical industry is anybody who asks for pharmaceutical services or for pharmaceutical product, not the property, plant and equipment. Similarly, a customer for engineering services is all that engineering equipment and engineering service, not any other item that he actually deals with. So what are the ordinary activities that the entity has, or entity is basically indulging itself in? Those activities, if they are sought after by anybody, that particular party will become customer. Now that the other party has become a customer to me, obviously I need to evaluate the whole transaction under Ind As 115. So the first and foremost objective is, as I said, the scope paragraph articulates, I know the scope paragraph emphasizes more on defining who the other party as a customer is. So not in all circumstances, the aspect of, see, predominantly whether the person is customer or not is very direct. But in certain circumstances, the aspect of whether the other party is my customer or not, is there anybody else, depends on the contractual arrangement. I'll give you a small example. Let's assume that you are, an internet-based advertising service provider, basically, who looks after various spaces that are available in media, electronic media, as well as print media, and will go to various corporates and will say, boss, these all spaces are available to you for the purpose of promotion. Just like a platform provider, you call it Make My Trip or 1NG for the in pharmaceutical industry, or for that purpose, Amazon or Flipkart, who are actually a basic platform providers. Who is customer to you? Let's take the same example. In the case of that internet-based, advertising service provider, you are doing a particular activity of buying that particular space from the media. You yourself will buy and will go to the corporate and say, boss, I am offering you so much amount of space. When you open, say, Republic TV, obviously the sound travels faster than the light in that particular channel because of one gentleman. So in between, let's assume that there is a 15 seconds break that he will take. during that 15 seconds that you can actually advertise. If you say that that 15 seconds time I am giving to you because you have pre-purchased that particular advertisement space from Republic TV, the customer is the corporate that has asked for the advertising space. On the other hand, if you clearly behave like an advertising space provider, you bring Republic TV onto the table and say, for example, Make My Trip onto the table and say, not Make My Trip, any other corporate onto the table. First, you can have, both of you can have a conversation and obviously can decide the terms and please give me a commission. Obviously, your customer is the party, Republic TV, whoever is paying you the final commission. And in the earlier case, the corporate that is actually trying to advertise that much amount of, print media space or as well as electronic media space. Same is the case. I might have taken a little laborious example. You can take jolly well Amazon itself. When you order something in Amazon, you know who exactly is the vendor there. Basically, vendor-based rates you can say. So Amazon and Flipkart are only a platform providers. Same is the case with Make My Trip. But if you go and read Make My Trip's annual report, also Amazon's annual report, the accounting policy for revenue has 2 paragraphs where Make My Trip acts as a principal and has bought certain flight tickets and rooms from various hotels. Make My Trip is the principal in that particular arrangement and all the travelers are my customers and I will recognize revenue on a gross basis. And on the other hand, where Make My Trip is only acting as an agent and making a platform provision, only the commission amount is recognized as revenue. So you can take n number of examples. You will see when you are actually walking by many car dealers, not all car dealers buy all the cars that are being displayed. They are basically a platform provider. They will bring the seller to the buyer. They will marry both buyer and seller and they will take the commission. So what is your position? What are actually doing there basically is what determines whether or which party is your customer or not, kind of a thing. Yeah, that said, there are certain areas where it is little slippery when it comes to whether the other party is my customer or not, kind of a thing. Say, for example, a collaborative arrangement. Typically, I will tend to take for ease of convenience a pharmaceutical example where 2 parties have come together and they collaborated to develop a new molecule. So to say, let's take for example a COVID vaccine kind of a thing. Not all transactions that are being done by these 2 collaborating partners are the transactions that will fall under Ind As 111. Sometimes there are a few transactions that are outside this collaborative arrangement and one party might act like a vendor and another party might act like a customer. So don't think that in case of collaborative arrangements, whatever the transactions between the partners are purely Ind As 111 and I will deal with these transactions only from Ind As 111 point of view. Need not be. So you need to obviously take into cognizance what actually role is played even by the collaborative partners. Especially in these kind of scenarios, you need to be a little more vigilant as to whether Ind As 115 is applicable or Ind As 111 is applicable in this case. Interactions with other standards. Whenever in your revenue recognition entry, apart from cash, if there is any other entry which is guided by any other accounting standard, the accounting standard says only one thing. First, follow the principles of recognition and measurement under the standard. So the revenue accounting standard takes a backstage. I'll give you a small example. I have taken investments in an entity, or so to say, I have taken shares of an entity as a consideration for the service that I have done to that entity. Entry is investments account debit to revenue. Now, can this transaction be viewed as purchase of investments by rendering some service, or should the transaction be viewed as consideration is in the form of investments for the whatever the service that I have done for them? Answer is whatever may be the thing you take, accounting is first recognize the amount that will come under Ind As 109. So first fix the debit and then go for the corresponding amount as credit. So you won't actually go through measurement of transaction price and all that stuff. Say in this kind of an example, investment account debit to revenue account, what will be the value of this investment amount under Ind As 109 is what you will put it, and a corresponding credit you will take. So the measurement is to an extent taken away off. Recognition, that does not mean recognized to be, it has to be recognized immediately. Recognition principles are as per step 5. Only thing is, whenever there is an interaction with any other accounting standard, that particular accounting standard is first given preference of. Yeah, now let's come to 5-step approach. The first and foremost, identify the contract with customers. See what exactly the standard is trying to basically bring forward when it starts saying that the revenue recognition evaluation starts with identifying the contract with customers. It says, see, it's like if you want to play a particular game, the game has to be played within the framework of that particular sport. That means you have to play the game by the rules. The rules and regulations of this revenue game are nothing but the contract with customer. What is that one foremost thing that the standard is harping on with this step 1 is, first make sure you are very much clear about, you in the sense both the customer and the seller, both are very clear as to what sort of enforceable rights they have and what sort of obligations that they have in this particular contract. So the first and foremost step is entity must have to identify the contract. Just to give you, interestingly, the word contract, there are 2 definitions for the word contract in Ind As. One contract is one that comes under Ind As 109, contract to receive cash, contract to pay equity instruments, that kind of a contract. Another contract is contract defined under Ind As 115. That's okay, just only for sake of saying. Next, what should be the objective of this particular contract? Should contract only be written? Can the contract be in any other form other than written? Yes. Contracts can be written, contracts can be oral, contracts can be implied. That's what the first slide meant in my presentation. Constructive obligation concept has been crept in the accounting standard Ind As 115. So contract can be, in a way, agreed upon, in a written contract or an oral contract, or so to say, an implied contract. Written contract, I need not explain specifically, it's both the parties will come together and approve of the contract. Approval of the contract is very much important. In case of a running contract, where the price is not yet determined, should we still consider the approval of the contract as a mandatory step? Answer is yes. In fact, for evaluation of this particular step, it's not always the only accounting brain that can come handy. Sometimes the accountant might have to deal with the legal, team to understand what sort of enforceable rights that we have and what sort of obligations that these kind of agreements between the parties can create in a court of law. So some sort of legal interpretation is also needed, not in plain vanilla cases, but in exceptional cases. Sometimes it has to be with the, under the aegis and under the help of a legal team. Can the contract be oral contract? Yes, very much. Most, a common example can be IT services, and very, very common is even the antivirus services. Sometimes if the virus gets hit, basically your system gets hit by a virus, obviously you will generally be able to solve it by speaking to the antivirus team, which frankly speaking, it happened practically with me and where I had to deal with that kind of a thing. So they clearly asked me, now this particular acceptance by you is going to be a contract and we will take it to a court of law if at all you deny making payment. So they say that why don't you, accept orally that yes, I will abide by the contract and then we will deal with whatever the issue that your system has kind of a thing. So there are oral contracts and implied contracts as such. Even whatever that is there in blue in this particular side is about the IT services and as well as those antivirus services, that kind of an example. Okay, now what sort of attributes that a particular arrangement between the seller and buyer should have in order for that particular arrangement to be construed as a contract? We must have read in our Indian Contract Act one statement, right? All the contracts are agreements, but all the agreements are not contracts. In a way, whatever the parties agree between themselves, that may or may not be in economic terms contracts, but in accounting terms, if it has to become the definition of a contract with customer, it has to have certain fundamental attributes. What are the attributes that have been asked by the accounting standard for an arrangement to take the form of a contract? Very, very logically given, basically. First, the parties have approved the contract and are committed to performing the contract. Why that concept of approval and commitment are taken into picture? Because the accounting standard clearly says you need not evaluate a particular transaction which is wholly unperformed. There is a word called wholly unperformed contract, which is explained by the standard in the contract term paragraph. So if a contract is wholly unperformed, and if either party unilaterally can terminate the contract at any point in time. See, imagine when and how, under normal economic parlance or under normal economic circumstances, both the parties are free to walk away from the contract without any penalties. That means the parties are not committed to contract. Why these kind of principles are coming into picture? Just to avoid many companies abusing the position that by creating a document between the parties and by mentioning somewhere in the termination paragraph that both the parties can walk away from the contract by giving a 10 days notice. Entire contract is not actually a contract under revenue recognition standard. Meaning there is no step 1 at all. The moment step 1 is not there, you won't even go to step 2, 3, 4 and 5. So forget about revenue recognition until and unless you establish that there is a contract with the party. So what sort of attributes that the contract should have? The parties must have approved the contract and are committed to performing the obligations with respect to matters enlisted in that particular contract. Secondly, I have not only approved the contract, I understood what my obligations are and I understood what my rights are. Obviously, business is not charity. I am doing business here, so I am obliged to doing ABC and I am entitled to receiving XYZ. Third, very interesting point, payment terms are identified. It's not about amount is identified. It is payment terms are identified. First, I will do ABCD activities and you have to give me XYZ, and this XYZ will come to me in PQR months. So at least payment terms have to be identified. Second and the fourth one, the transaction has commercial substance. Where else the word commercial substance has been used by this particular accounting standard or in Indian accounting standards? If you see non-monetary exchanges in Ind As 16 or Ind As 38, they uses non-monetary exchanges between the parties that lack commercial substance are not accounted for. Similarly, if the transaction has commercial substance, that means the configuration of cash flows should change before and after for both the parties. That does not mean you should not sell the product at cost. I can sell the product at cost, and when I'm selling the product at cost, obviously the configuration of cash flows will not change significantly, but that does not mean that. Basically, he is coming from a point of view, because when you are doing some commercial transaction, definitely the element of charity will not be there. So just to say, to rule out the possibility that no charity is involved, is bringing out into the concept that the commercial substance exists for a particular transaction so that it can be construed as a contract. And the fifth point, very, very interesting point, and from a logic point of view or from economics point of view, it no way, frankly speaking, gets related to whether a agreement can become a contract or not. You know what is the fifth point? It is probable that the entity would collect the money, meaning a thoroughly executed legal contract with a customer in Ukraine now can be a transaction under economics, but not a contract under Ind As 115. If you have any doubts with respect to collectability of a customer in the wake of war between Russia and Ukraine, because you now significantly perceive a credit risk from the customers in those localities, or significant delay in terms of collectability, whatever the questions you have. What do you mean by the word? It is probable that it would be collected, same as Ind As 37, more likely than not. Meaning the percentage of collectability, the management's assessment has to be greater than 50%. If I believe that I will get the money from the customer and it is probable that I will collect the money, obviously I can go ahead and evaluate the transaction from step 2, 3, and 4. Please bear in mind, assessing the probability of collectability does not mean revenue can be recognized. I'm not talking about recognition of revenue here. I'm talking about what attributes an arrangement will have so that it can become a contract. So if it does not have the attribute of collectability, it is a harsh position that has been taken by the standard and says that there is no contract that is in place between the parties. Why it was taken? The basis for conclusion paragraphs of the parent accounting standard very clearly articulates it is basically introduced, to avoid entities from taking significant hits on the day 2 of recognizing the revenue. So recognition of revenue is not an option. So I have to recognize revenue, but I will evaluate the transaction using other principles, and then I will say, boss, this is not actually a collectible amount, and I will make a credit impairment, or I will go for credit loss of this particular receipt. So rather than creating a volatility in the profit and loss account, the standard introduced a concept, although has taken a hard stance. If it is probable that the entity will not collect the money or will collect the money, as the case may be, please go ahead accordingly. If it is not probable, don't consider that there is a contract with the customer, and don't do anything till the time you establish that particular position. Now, why this particular collectability needs to be so much emphasized on? Don't think in a normal scenario where a medicine is sold, or a garment is sold, or a particular car is sold. Think big kind of infrastructure companies, or companies that deal with governments of other countries. Hyperinflationary economies. You have entered into a contract with Venezuela, Zimbabwe, Sudan, Lebanon. The country government itself will come to you and place an order. Now you will accept the order, but will money come from that particular government? Yes, it is entered with government, but there the governments themselves have become they go broke, or they went broke, in fact. So it's always it's not always plain vanilla position that money will be received if it is entered into with a particular party kind of stuff, or with a particular government kind of a thing. So a government of India contract might be 100% secured, although it is little delayed. But a contract with government of Venezuela, Zimbabwe, Argentina, definitely not. Definitely not in the wake of hyperinflationary position that the particular country is facing. So there are definitely particular transactions which need to be evaluated from collectability point of view. That's the reason why standard itself very clearly says these particular provisions, the standard rarely expects entities to stop evaluating further based on collectability. Second, one more important point, what happens when there are master service agreements? Master supply agreements or master service agreements, which are followed by purchase orders or which are followed by service orders. You need to see both together. If you see only master supply agreement or master service agreement, which only enlists the framework and may not bring you any enforceable right. It's like memorandum of understanding kind of a thing. what a memorandum of understanding can bring an enforceable right in a court of law? Obviously not. That's the reason why I said sometimes, you know, a helping hand from legal team is very much needed in order for you to evaluate whether there are enforceable rights at the same point in time. Are there any obligations that are creeping in because of whatever the promises I have made with that particular customer? Okay, next. We have seen payment terms identified, commercial substance, collectibility is probable. Yeah, as I said, see the bold item. It is generally expected that only a small number of arrangements may fail to meet the collectibility criteria. Here I'll bring some one example here. Just follow this example. The collectibility threshold arrangement is based on, just a second, I'll move this screen aside. Yeah. Company C contracts with customer D to sell 1,000 units for a fixed price of 1 million. D has a poor payment history and often seeks price adjustments after receiving orders, and so C assesses that it is probable that it will only collect 70% of the amounts due under the contract. See, here there is an element of judgment when you are evaluating collectibility. What is that element of judgment? See the language that has been bolded and underlined in the second paragraph. Based on its assessment of facts and circumstances, C expects to provide an implicit price concession and accept 70% of fixed price. Say, for example, you have gotten a contract now from Ukraine, and the price is, say, for example, $1 million. But you know, Ukraine is going through some financial difficulties because of the political scenario or the economic scenario there, and you will only get $600,000 or $700,000. So, as a management, it's not evaluation by auditors or it's not evaluation by accountants. As a business head, if the entity itself is going to a position that I will only get 70% of what I am billing, the collectability is established to the tune of 70%. Now, don't get confused just because 70 is above 50 here. I'll take the same example in a different way. Let's assume the company believes that only 300,000 will be collected from this particular party, and the balance 700,000 or 70% is a price concession that I am going to offer to the customer. So the business finance, so the business heads themselves know that they are ready to do a contract of 300,000. Don't think that it is lower than 50% and the money to be collected is only 300,000. I am more than 50% convinced that I will get 300,000. So the most important thing is the area that requires judgment. Is the entity providing implicit price concession, or is the entity making a statement that the collectability will not come to me? If the money doesn't come to me is your assertion, you are doomed. Your step one doesn't meet. If you say that no, I will get X amount of percentage, balance I myself consider that it is the implicit price concession. I believe that the value of the transaction itself is 30%. Balance 70% anyways I am going to forego. I am fine with it. Then you say that to the extent of 30% the revenue recognition step one is met. So always be careful. The difference in statements by the entities that I'm not perceiving or I'm not probable that the money would be collected versus I will collect some percentage and the balance is price concession. That's the point that I wanted to here make. And on the subsequent reassessment, if entity C expects, so in this example, he believes that 700,000 is the base amount that he would collect. So from 1 million, he would recognize, he says that 700,000 is the value that would be considered for the purpose of step 2 and 3. So he will go to step 2 and 3 for evaluation at 700,000 and see what is there. In the subsequent reassessment, if C expects to collect more than 700, it recognizes the revenue. But if C expects at a later point in time that it will collect only 600,000, it's not vice versa adjustment of revenue. it first needs to be evaluated whether it is an impairment of receivable, whether it is a bad debt or not. Only when once the entity says, boss, this 100,000 is also a price concession given by me, then it goes as a reduction of revenue. As I said, this particular point is easier said than done. It's very, very difficult for an entity to evaluate whether there are implicit price adjustments or whether these are actually in the form of conclusions made by the entity that money will not come to it. Okay. You can go, I just have jotted down some of the key points here. You can go through that and I will just move on. Unlimited decides to enter a new market that is currently experiencing economic difficulty and expects that in future economy will improve. That means as of now, it's going through financial difficulty. M enters into an arrangement with customer in new region for networking products and the consideration is 1.25 million. At contract inception, N expects that it may not be able to collect the full amount. It does not mean, as I said, the objective of the entity is to identify, is there any implicit price concession that you are agreeing on day one? Or are you saying that I have to receive 1.25 and currently I don't believe that 1.25 will be received? All the best. You have not in a way have moved further from step one. Step one is not met. You will not go for evaluation. You will go for evaluation only when once the step one is met. On the other hand, I believe that okay, 700,000 will come to me. 700,000 will move to step 2, step 3, step 4, and 5. Collectability is probable in case of portfolio of contracts. Take the same example. Say, for example, you are dealing with, you have a pan-India, basis, and you know that 5% of your customers will not pay, but you will not be able to point out who that 5% of customers will be in terms of, not rather than saying 5% of customers, 5% of value of the sale will not be received per annum, but you will never be able to point out who those customers would be, who will default. Pretty much possible in an emerging country. So you, based on this kind of a scenario, should I stop recognizing revenue if I deal with these kind of cases? Or should I recognize revenue only to the tune of 95%? The answer is, in case of portfolio contracts, means where a particular geography or a set of customers or a cluster of customers are evaluated, you will go ahead and recognize the revenue by making an expected credit loss for the amount that you expect that you will not receive. So it is not non-recognition of revenue. It is a practical expedient that has been given by the accounting standard with respect to portfolio of contracts. Collectability is probable. So when would you go for reassessment? Like balance sheet, it is not done every quarter for each and every customer the company deals with. If you believe that, okay, this customer is good to go, you will reevaluate like impairment only when once the condition triggers for the purpose of reassessment. Similarly, when once you believe that something positive has happened with the customer for whom you previously have said that I will not have collectability, then you will start reevaluating. It's not that monthly I will evaluate, quarterly I will evaluate, every balance sheet date I will evaluate. It's not that. Consideration received before the contract exists. So we have understood that we entered into an agreement or some arrangement with one customer, and we understood that this particular arrangement, we evaluated whether this falls under the definition of contract or not, and we understood that this arrangement is not a contract, but by which time you have received some money, and that money is non-refundable. How should company evaluate this particular transaction? What should or where should this money be disclosed or presented in the books? And I repeat, the money is non-refundable. Let me give you a small example which I have picked up again from one of the advertisements. You must have heard of Bonville chocolate, right? Bonville chocolate comes with a tagline, "Not so sweet" is one. Another one is, it's not just a chocolate that you can buy, you have to earn it. So you have to earn that chocolate to eat it. Similarly, revenue recognition presupposes the aspect of revenue earning activity. You should earn your revenue. Merely signing the agreement and receiving a non-refundable upfront amount does not mean you can recognize revenue. I repeat, non-refundability of an upfront amount does not mean it is revenue. If you cannot demonstrate what is the revenue earning process that you went through in order for you to get so much amount entitled to by you, you will not recognize any money in revenue account. You will put that money in liability and you will start reassessing till the time a contract gets established or till the time a performance obligation gets carried out by you. I repeat, non-refundability of an upfront amount where you can't demonstrate what exactly is the earning process. It's all done for the previously completed activity. Now the customer is accepting whatever I have done. That's why upon signing he is paying money. Absolutely no. A big no. You will get zero in your revenue account. Non-refundability does not mean anything from revenue recognition standard. Now, combining of contracts. So you have entered into a particular contract today, you evaluate, arrangement today, you evaluated whether this becomes contract or not. Now come to a position that yes, it becomes a contract. After 30 days or so or 45 days, you have entered into another contract for similar set of activity for a different consideration. Now the standard poses a question, should these two contracts be combined? When, if at all the company has to combine, can the contracts be combined? It gives a guidance. It says if either of the following characteristics is met, then the company has to combine the contracts. First and foremost thing, the contracts are negotiated as a single commercial objective. That means I am buying 30 units now, and after that I will buy another 50 units because I am already buying 30. The price of this particular 50 and 30 are little interdependent. That's what the second point is. The consideration to be paid is dependent on the price and performance of another contract. And the goods and services promised in a contract are a single performance obligation. Don't jump the gun. You will understand the third point once you know the step 2. So in case of combining of contracts, the guidance is if the contracts are entered into at or near the same time. What do you mean by at or near the same time? For convenience sake, I said 30 days, 45 days. Is it 1 month? Is it 3 months? Is it 6 months? It's judgment. No bright line guidance that has been given by the accounting standard. It says entity has to take into cognizance the economic factors that prevailed during the elapsed period. What made me sign the contract after 30 days? What made me sign the contract after 45 days? Is there a genuine reason for me? Is there a particular point where both the parties had a disagreement which has been now solved? That's the reason why the original contract and the other contract has been signed in a different, with a gap. Or are they genuinely two different contracts? If they're genuinely two different contracts, I will account for these two contracts on their own. So you need to understand what economic conditions and situations have prevailed during the elapsed period. That's the guidance. I have given the example. I'm given the paucity of time. I'm just moving forward. Contract modifications. This aspect of contract modifications I will cover after completion of step 5. Because contract modifications use some language which predominantly comes from the second step, distinct performance obligation, and in step 4 where the standalone selling price is used. These two words are very, very commonly used when we are talking about contract modifications. So even if I forget, please you do make a note of it. If I forget contract modifications after completion of all that stuff, if I couldn't complete, just do let me know. I'll complete it after completing the step 5, because it does not make much sense by covering the contract modifications now without learning the step 2. So I'm just pausing here. Yeah. Identify the performance obligations. I would say one of the most crucial steps in revenue recognition standard is step 2. So you entered into an arrangement with the customer. You evaluated whether the arrangement has attributes of contract. You evaluated whether one more arrangement of yours has to be combined or not. So all these you have understood, and now you need to identify what sort of performance obligations are there, what all you have pledged that you would do, what all you have promised that you would do as per the contract are there in the particular piece of paper. Now we need to evaluate it from the step to identify the performance obligations point of view. See, the accounting standard uses the word identify the performance obligations. It's an accounting word. Promise is an economic word. So you might promise many things, but not all the promises become performance obligations. So a promise becomes a performance obligation only if that promise is distinct from the other promises. So I might say I will do A, B, C, D, E, F, G, H, I, J, R 1 to 10 promises, but not all the promises become performance obligation. What the accounting standard says? Accounting standard says all the promises in your arrangement have to be evaluated and be seen whether they become the performance obligations or not using the following guidance. What is that? See whether these promises are distinct or not. If it is a single obligation, in case of a series of obligations, try to get the cluster, series of distinct performance obligations and then keep them aside. At the same point in time, also evaluate whether these are distinct in the overall context of the agreement or not. We will understand these jargons as we move forward. I will not move the slides. I will first explain the whole concept now, then probably we will see whether if I've missed out anything in that particular slide. So coming back, I have made some promises in the contract that I will do A, B, C, D, E to the customer. Now my obligation is what sort of promises would become performance obligations. As I said, not all promises become performance obligations if a particular promise is distinct from another promise, it becomes performance obligation. What do you mean by distinct? Distinct is it is written from a customer point of view, meaning it is not from the seller's point of view. A particular promise becomes distinct if it has a standalone value to the customer on its own. I'll give you a classic example which I have been using for quite some time because I read it in one of the accounting books. The manner in which Axe deodorant supplies the product. You know how Axe deodorant supplies the product? Say for example, you have asked for 1 million bottles of Axe. And he says that I will take 3 months of time to deliver you the entire product. How generally what is that we will be there? What is that will be lingering in our mind? Maybe 300,000 will come in first month, another 300 in second month, another 300 in third month. But interestingly, Axe supplies the product like this. The first consignment, very excited, I opened the container. What I could see is only the nozzle with that particular straw. Nothing else, only the nozzle comes. Next month, another consignment, only the bottle comes. The so-called substance in that bottle, liquid, semi-liquid, gaseous state, whether it is gas, whatever it is, I don't know, that thing comes in the third consignment. Now tell me, from a customer's point of view, what is the standalone value of the delivered component with that nozzle as well as the bottle? It's of no use to you. I can't get the undelivered component from a third party market participant. So what do you mean by distinct? Again, come back to the position. If it can give you a standalone value to the customer, I have supplied you the car, you can get the maintenance services from somebody else. I have supplied you the liquid in that particular Axe deodorant, you can buy the nozzle from third party. So am I creating any value to you by delivering something to you in the first place? That's the reason why you can again go back to the point. Just by merely signing an agreement, what sort of value the customer is getting, even the non-refundable amount qualifies to get recognized as revenue. That's then another way to say why non-refundable upfront amount will not get recognized. Because the customer will not get any perceivable standalone benefit from whatever merely signing or whatever the nozzle that you are delivering to him. So same is the case with, say for example, software that is supplied to you with significant customization needed. Without customization, what would I do? But don't take the examples like I bought a television needs to be installed. Only in India, only Indians will call for installation. Generally in the world, these things can be done by respective people immediately after buying. So don't take that kind of an example. Say for example, take some larger than life kind of an example. Say for example, a big machinery needs to be erected. Obviously, that particular erection needs under the supervision of a particular seller. So the seller has to come and has to install that particular machinery there. So think of it in a different way. Is the seller's service needed, or is the seller's interference needed in order for me to get the value of the delivered component? Or can I get the remainder of the service from a third party market participant readily without loss of time and effort, can integrate with whatever the customer has sent, whatever the seller has sent to me, and can get the benefit? If the answer is yes, whatever the seller has sent to you in the first place is a distinct obligation. If not, if the seller has to do another activity, only then you will be able to get the benefit out of it. Then obviously these two promises are not two different performance obligations. The two will become a single performance obligation. Again, I am not opining on point of recognition of revenue or the amount of revenue. I am only saying that these two promises become a single performance obligation. So it's like this, stick by stick, I will keep on adding all the promises. If they are independently not distinct, I keep on adding non-distinct promise with another promise. Now I will see, will this become a standalone performance obligation? No, I will add another promise. Now these three promises will become a performance obligation. Yes, I will put this one particular performance obligation aside. Now I will evaluate the remainder of the promises. So it's more so needed. I will give you a classic example from the industry I have dealt with. You have sold one marketing authorization, and the marketing authorization has to be supplied with. That means you are buying a brand to sell that particular product in India. Say for example, what do you say? Serum Institute got the technology or the contract to manufacture so many units of Covishield. And after that, there will be a technology transfer that happens from GSK to Serum Institute. Without that, obviously the initial contract has got no value. Or so to say, somebody has sold me a brand where without actually supplying that brand to me, what will I do by owning that particular brand if the material doesn't come to me? In a regulated market, sometimes in some of the industries, it's not that easy that you just buy and sell the product. It operates in some highly regulated environments. So it's not just the asset or a piece of paper that gets transferred to you. It has to be backed up by supply of inventory as well. So it's pretty common in pharmaceutical industry that a supply of brand or a sale of brand, the piece of paper brand, will be backed up by some supply commitments. Without the supply of the product, how can I sell that Dolo 650 or how can I sell that Cross in advance of 650? Just by owning that, I can't actually derive any benefit. So it has to be backed up by supply component. So the money that I would get for sale of brand and money that I would get for sale of product are not two different promises, but rather they will become a single promise. In a very, very shrewd and crude way of explaining pharmaceutical industry. Not that it happens every time in that particular way only. Okay, it's predominantly operates in that way. So the first and foremost thing is identify what are all the promises in the contract. Sometimes certain promises are implied, sometimes certain promises are explicit. As I said, implied promises also will become performance obligations if it is established that the entity would end up doing this kind of a service. What is the best example for implied promise? If you have taken the Hindu group's subscription for print media by paying 2,400 annual subscription, you will be given access to various types of journals, the Hindu, Business Line, Outlook, or whatever Sports Star, etc. They will also have one statement at the end. The subscriber to print media is also given access to online content of these particular journals. There, if you actually see the revenue recognition principles of these media tycoons, you will identify that these two are two different performance obligations, because first of all, the structure itself is different and the form in which they are held is different, and one can independently be. Two people can independently get the benefit out of these two forms in a different way. So one example is that where implied promise is basically becoming a performance obligation. After evaluating how many promises are there, see whether these promises become distinct or not from the point of view of whether they have the standalone value to customer or not. If they have the standalone value to customer, that promise becomes a performance obligation. Once that performance obligation is kept aside, you will now count how many number of performance obligations are there. This is the guidance for individually identifiable distinct promise that has been identified. Now there is another way of rendering the service where same sort of service is repeated over a period of time. This kind of an arrangement is entered into by almost everybody, and everybody is aware of this kind of a transaction in their lives. Best example is the maid who comes to our house and who does the cleaning for 1 month. Let's assume that 2,000 rupees is the consideration for 1 month services. It is not evaluated. It basically means a distinct performance obligation is carried out on 30 different dates to earn that revenue of 3,000 basically, or 2,000 rupees. So what the standard says is, what don't consider that each and every day, each and every service activity as a separate unit and start recognizing on a daily basis, rather recognize it as a series. When once you have done the whole set of activities at a later point in time. Another example is IT readiness or IT services that are offered by all these server maintenance guys, or these antivirus service providers, cleaning services, security services. All these will form under the category of series of distinct performance obligations having a homogeneous pattern where there is a symmetric and reciprocative receipt of service as and when the seller is rendering the service. So 1 day of security services provided is 1 day of security services received by me. So at that point in time, it's basically 30 distinct performance obligations. Although it is a single promise of providing security, these are 30 distinct performance obligations. That's what he says, and says for each and every completed performance obligation, recognize the revenue. That's where the concept of recognizing over the period came into picture. Because the fundamental point, that is basing point, is nothing but these are individually distinct performance obligations falling under single promise. So various promises can become one performance obligation. Each promise can become one single performance obligation. In a series category, one promise can become 30 performance obligations. Why performance obligation? Performance obligation, that is the unit of account for revenue recognition. You account for revenue for each and every performance obligation. So for each and every day of service rendered by the security, you will recognize revenue, from where the concept of over the period has come into picture, which is nothing but recognition for the completed performance obligation. So I repeat the overarching principle. A single promise can become a single performance obligation. More than one promise can become a single performance obligation if they are not distinct. One promise can become multiple performance obligation if it is a series concept. Clear? Next, we will go to some of the practical concepts that have been introduced from step 2. The standard is written very, very meticulously and beautifully by introducing one practical scenario or kind of a situation kind of a thing has been introduced wherever it is predominantly necessary to be introduced. So when once you have identifying only step 2, in that step 2 he covers certain aspects. What are those? Basically principal versus agent consideration. What do you mean by principal versus agent consideration? We can go back to the same example of Amazon or Flipkart or Make My Trip or 1MG or whatever may be the example where the platform provider thing comes into picture. Here there are 3 parties: the platform provider, Amazon, and the vendor and the customer who purchases the product. You know how beautifully the language is there in the standard. He says when more than one party is there in the contract to serve the customer, the other 2 parties have to determine who is the principal and who is the agent. How do we determine who is the principal and who is the agent? Same uniform principles. Whoever controls the transaction becomes the principal. Whoever follows the instructions or whoever is controlled. Keep aside the customer. I'm talking about Amazon and the vendor. Who is controlling the transaction? The vendor who is supplying the product. Who is getting controlled? Amazon as a platform provider is getting controlled. Rather than using this language, let's use the guidance that is provided in the accounting standard. Accounting standard gives 3 principles in determining principal versus agent considerations. Who is the primary obligor in carrying out the obligation? Meaning, who has the first responsibility for the product asked by the customer? Does Amazon have the responsibility? No. It is the vendor who has the responsibility to supply the product. So who is the primary obligor in delivering the product or in rendering the service? The primary obligor is who? First point. Second, who takes the inventory risk? Who possesses the inventory? It's not the legal ownership. As I said, who is the custodian of inventory? Amazon now has some warehousing services as well. Warehousing service means only a custodian service. Inventory risk is not taken by him. Inventory risk still resides with the supplier himself. So who is the primary obligor? Who is the owner of the inventory risk? And who has the latitude in determining the prices? 150 rupees is the price of this particular product. Who is determining it? Is Amazon determining it? Or is the vendor who said that I will sell the product at 150? That's the reason why in Amazon, he said the 300 to 4, whatever, this X to Y price is available from 7 other vendors. So the vendors are free in determining the price at which they want to sell the product. So the latitude in determining the price is with the vendor himself. The inventory risk is with the vendor. The person who is the primary obligor in delivering the product is vendor. Although the service is coming in the package of Amazon, Amazon is not the primary obligor, Amazon is not the principal. It is the vendor who is offering all these aspects or having these kind of things with him. So it is the vendor who is the principal, Amazon who is the agent, customer is customer. Sometimes these are mixed. Sometimes they can shift positions. On a $1 billion day, Flipkart purchases the product from the vendors and puts it on his own risk and offers extra discount to the customers. At that point in time, Flipkart is the principal. He recognizes the revenue on a principal basis for the full gross amount. Rest of the 364 days, he recognizes the revenue on a commission basis. Clear? Consignment arrangements. I don't think so any special guidance is needed because all of us must have been through consignment arrangements, either from our probably I would say intermediate stage onwards, not CA inter, board of intermediate stage onwards. So I'm not going to spend too much amount of time. The answer for consignment arrangements in the IFRS 15 is no revenue, because you are just an extension of my marketing arm. You are just my particular dealer of that particular product. You are not even, so nothing has been transferred to you. The control has not been transferred to the customer or to the consignee agent. So obviously control is still with me. He is obviously expected to behave as per my whims and fancies, so I will not recognize revenue. Next, customer option for additional goods and services. Although the standard uses the word customer options for additional goods and services, the most colloquial language or the statement for this particular thing is loyalty programs. What do you mean by loyalty programs? I will give you a basic example, and based on that probably we can go forward. Whenever you go to, say for example, Central or Shopper Stop or whatever it is, you made a purchase of say 10,000 rupees. That fellow gave you a gift coupon. Gift coupon is 2,000 rupees of discount if you purchase 5,000 worth of goods at a later point in time. As a typical Indian buyer, I will turn that particular coupon and see what is the last date. As usual, the last date might be today or it might be tomorrow, because that's how generally they will design. And obviously they will put you in a particular hurry so that you will buy it. So not all the customers are inclined or interested towards monetizing that particular benefit. A few customers definitely would try to monetize that particular benefit by purchasing by extra 5,000 so that I can get the 2,000 rupees. So what is the key point here? The key point here in identifying customer option for additional goods is material right of discount. See, who is getting the 2,000 rupees of gift voucher? The person who bought the product for 10,000 rupees is only getting. So what do you mean by the word material right of additional goods? Any right that is not available to general public for rest of the people, but it is available only to specific set of customers because they have dealt with the company in a particular way, is basically called a material right. Means a Dasara discount of 10% is available to everyone, but because you are my loyal customer, we can give you, say for example, if you are our member, if you have our membership card, during Dasara you will get 25% discount. That extra 15% is the material right. That is a loyalty program. How does the accounting standard look at that particular loyalty program? Very interestingly, normal logic and normal economics says it can be a discount. Although it goes as a cut from revenue, it's not exactly a reduction of revenue. It goes as a non-recognition of revenue. What the accounting standard says is, whenever the customer has a right of discount for a future transaction, I repeat, whenever the customer has a material right of purchasing additional product at discount, that right of purchasing the additional product at discount is considered as an additional performance obligation. Little difficult to digest, but listen to it and probably if you regurgitate it over a period of time, you will be able to get it. It looks like a discount, but no, standard doesn't look at it like a discount. It's not a trade discount. It is entity has a pending performance obligation to offer him 2,000 rupees of discount for a future purchase of 5,000. So that guy came again day after tomorrow and he bought worth rupees 5,000 and he paid only 3,000 rupees. What is the entry on day one? Bank account debit 10,000, to revenue account debit 8,000, to deferred revenue 2,000 rupees, which is nothing but the fair value of the material right. And at a later transaction, when once he gets bank account debit, I will only get 3,000. This deferred revenue account debit 2,000, to revenue account 5,000. Between the two transactions, what is the total amount of revenue I have received? I have recognized 8,000 plus 5,000, 13,000. Between the two transactions, what is the amount that I have collected? 10,000 plus 3,000, 13,000. So 10 plus 3, 13 got fragmented into 8 plus 5 as revenue. That is the accounting for loyalty programs. It is a plain vanilla example which I have given. They can go to a very, very different zone and to an extent a completely unrelated industry matters also can come into picture. Say for example, a jewelry dealer can give you a tickets for travel to another country. Even then it can become a customer loyalty option. Don't always think material right for purchase of additional product or entitlement of discount can always happen with the products that he deals with. Sometimes it might have to be evaluated. Is there any crossing of line between customer incentives, selling expenses versus customer loyalty programs? So a plain vanilla example you can consider, and we can move forward. Now, sale of products with a right of return. What do you mean by sale of products with right of return? Many industries generally will have a general right of return. That means if you very normal thing is the expiry date on a particular medicine. The medical, you thought the medical shop owner will take the risk of not selling the product by expiry date. By even 3 to 4 months before the expiry itself, this entire product will be returned back to the manufacturer. And generally pharmaceutical companies, because I've taken pharmaceutical industry, it is easy and relevant to relate it. So a general right of return exists for most of the companies when they offer it to customers. When a right of return exists, the guidance under previous accounting standard was not clear. What is the guidance under Ind As 115 when it comes to general right of return? It says only one thing. Based on the past experience of the entity, what is the value that will come back to the company as a return, and what is the value that will not come back to the company as a return and I will get money for it. In a way, the standard asks the entity to identify what is the amount that will not come back as a return, because under variable consideration it says what is the money that you will get. So first the company has to identify what is the quantum that I will not get as a return. The balance amount is basically considered as a returnable quantity. What is the accounting treatment? You have to create a refund liability on the day of transaction itself based on your past history to the extent of inventory that is likely to come back to you. So money that has come to you, say for example 10,000 rupees, 9,700 is the value that I will not get as a return, meaning 300 rupees is the value that I will get as a return. 300 is the refund liability. It has to be presented as a refund liability and it has to be shown as other liabilities, and you need to have a reconciliation for refund liability from opening to closing. A clear requirement under the accounting standard. At the same point in time, it says one more position. When once you get the product back, you can create a contract asset. See, generally people can relate very easily. Whenever there is a allowance for sale return, a question arises, should cost of revenue be reduced or not? Now he has given a guidance. If the returnable product can be repaid and can be resold, I repeat, if it is resaleable and it is repairable, and that means I can recover my costs, then you can create a contract asset. Accounting standard is silent whether that contract asset should be presented as inventories or should be presented as another asset. Big Four also have a divergent view, but the uniform view is whichever may be the line item that is used to present it has to be clearly disclosed in the notes to account where the contract asset has been recognized in the books. So I repeat, whenever the company believes that X percentage of sales or quantity sold is going to come back to you, you have to recognize a refund liability. Carve out so much amount of money from revenue. It is not revenue. Don't recognize the revenue. Bank account debit 10,000 to revenue account 9,700 to refund liability 300 rupees. Now let's assume the cost of the product is 180 rupees. The industry, the company in which this particular industry deals with is where it can be normally recycled and resold within a month or month and a half times. So I will de-recognize cost of revenue by 180 and create a contract asset. So I am not recognizing 300 revenue. I am also not recognizing car of 180. Where is the other leg of car? Contract asset of 180. Should it be disclosed under inventory? Your wish. But it has to be disclosed the line item where it has to be, where it was considered, and consistently from there onwards the entity has to present that particular item in the same line item. This is in all in a brief particular manner with respect to step 2. Let me now go to the slides and see if I have missed out on any. In fact, whatever the examples I have told you are in a way verbatim whatever the examples I have mentioned. 9,700, 300, 180, all these are examples from you. Explicit promise and implicit promise, where I have mentioned in the bracket, see here, one more example, media company offering subscribers to print copies and online access. You can read for your own elaborate knowledge of revenue, select various companies, different industries, and start reading their annual reports for revenue recognition accounting policy. I won't say that you will be on top of revenue recognition for that company, but at least you will interestingly understand, you will get to know a lot of interesting concepts. How do these companies look at a particular transactions, and what is another way of looking at a particular thing? Yeah. One thing at the end of the day, I also said there is, in the overall context of the contract, certain items are not considered as distinct performance obligations. So although in these kind of three activities, the below three activities, which I am going to explain now, although there is a third party market participant who is available for you to do the activity, it does not make any sense for the entity to get these things done by a third party. What are those kind of services? Accounting standard generally identified under three categories. Any activity of, a significant service of integrating goods and services predominantly happens in real estate and construction industry. Generally, agreements are bifurcated. Say, for example, even if I have got a contract of construction of a hospital, the contract now reads as 5 to 6 contracts. Purchase of land, then leveling of land, then there will be construction of building, then procurement of machinery, installation of that machinery, and checking the entire operational qualification of that machinery so that it is ready for that particular entity to run a hospital there. All these independently can be done by anybody. But from a customer's point of view, the contract, what he always wanted, the service, what he always wanted is construction of a hospital. So although there is a bifurcation or a distinct nature that can be attributed, accounting standard says if that particular each and every activity has a significant aspect of integration, these are not distinct. Please do consider the entire construction of hospital as a single performance obligation. Again, I am not commenting on when to recognize revenue on that construction of hospital. Today, tomorrow, or over the period, that's all secondary thing. Second, significant modification involved. I bought S4 HANA licenses, but significant modifications and customizations are needed. Although can be done by somebody else, generally if you are buying that license, either SAP does or anybody else does. Even that service can be offered, even that license can be offered by, even IBM as well. IBM can offer the license of same S4 HANA from SAP itself, and it can only do the modification as well. So whenever there is a significant modification involved, generally those contracts are not considered as distinct contracts. Third one, highly interrelated and highly dependent transactions. Say for example, to take immediately the example of pharmaceutical industry, sale of product backed up by a supply contract. A highly dependent and highly related contracts, difficult to think of, although can be done by a third party, there are certain regulatory hurdles that would play around. Readily they are not available. So these are basically considered by standard themselves as, in these kind of three scenarios, these are not called separate performance obligations. These have to be considered as single performance obligations. All the examples, in addition to what I have already explained, I am skipping off in the paucity of time. You can go through and yeah, promised goods and services that are not distinct. As I said, a promise can become a performance obligation. Two or more promises can become one performance obligation. One performance obligation can be peeled into different performance obligations. Sorry, one promise can be peeled into different performance obligations if it is in the nature of series category. Principal versus agent consideration. Those who want to get an additional understanding of principal versus agent, although now that language is not available, you can refer to EITF 9919 of US GAAP. I stay put here. I will not explain further. Those who can note down that wanted to read further, you can actually read further. Consignment arrangements, customer option for additional goods. I've given one example here where you can actually go through. Sale of product with a right of return. I have fully explained, including with example, which the example comes at a later point in time. Now, determine the transaction price. So we are at 7. I don't know how many people are there, how many people need a break. Anyone needs break? Probably I don't say I will give you a break. I can pause for 5 minutes or 3 minutes kind of a thing. Is anybody there? Yeah. So we can assemble it. We'll take a 5-minute break.
Yes, sir.
Yeah, we will assemble it. What is the time now? In my watch it's 7.
Can you
7
around
months.
7:06 or 7:05, sir?
Yeah, fine. That would be fine. That would be, in fact, that would help me, in fact, to cover the concept.
I'll take the organizer right. Actually, the screen sharing right, sir.
Yeah.
So can we start the session, sir?
Yeah, I'm absolutely fine.
I'll give back
Yeah.
the presenter.
Yeah, now the presentation is visible.
1 second, sir. I'll give you the presenter rights.
Okay.
I've given you the rights, so now you can. Now you will be able to share it.
Yeah.
Yes, sir.
Yeah. Let's come back to the position. The third step, determine the transaction price. So sequentially, when we come back, the company has identified an arrangement with a customer, and the arrangement has been evaluated from a contract point of view. It has combined the contract. It has identified the promises. Let's say, for example, it has identified 10 promises. Of the 10 promises identified, it evaluated whether they fall under the ambit of performance obligations. Yes, it identified 6 performance obligations for the 10 promises. Now, what value and for what and for how much money these 6 performance obligations will be carried out by an entity. Let's assume the invoice price is identified at a lump sum amount of 1 lakh rupees. And there are certain other entitlements that have been mentioned. How does the accounting now look like with respect to right-hand side of an entity? So far, we have been looking at left-hand side of the transaction. What all promises are there? How many performance obligations are there? Now on the right-hand side, how much money I would get? Obligations have to be matched against the entitlements. Now the entitlement is, as I said, 1 lakh rupees plus or minus something is there. Now what is the guidance in Ind As 115 with respect to this monetary evaluation? Now monetary emolument, what is the measurement of revenue here? It says the revenue transaction has to be recognized at transaction price of that particular transaction. What do you mean by the transaction price? It is a reason, as I said, I stick on to my style of communicating. I will explain the whole step now in my flow, and then I will go through the slides. If I have missed out on anything, that I will cover up. Because going through the whole set of slide by slide will not give me that kind of an advantage from a time point of view. Because that's 3 hours is the only time that has been given to you. Now coming back. What do you mean by transaction price? Transaction price has been explained by the accounting standard as the most approximate amount of money that would be collected by the entity by executing the particular transaction and by completing the transaction. So by the time I complete the transaction, what is the most likely amount that I would get? The most likely amount is not the cash price. It is not the invoice price. It is not the list price. It is the transaction value or the transaction price, a accounting derivative of various parameters here. What does it say? In a simple mathematical scenario kind of a thing, it can be understood as invoice price plus or minus variable consideration is equal to transaction price. Now it introduces us to a concept called variable consideration. What do you mean by variable consideration? It can be any provision in the contract with customer that has the propensity to alter the money that I am going to receive at the end. Although I said 1 lakh to you, I may get 1,20,000 if I perform the contract by a specified period of time, performance incentive, or I might get the value only 98,000 because I might have to offer some volume-based discounts to the customer. Or I might pay some money back to the customer because of the defects inherent in the business in which I am dealing with. An automobile industry has to take cognizance of warranties. You can't say my cost of warranty is 0. Obviously, it does not make any sense because in this kind of a scenario, there is likely going to be some sort of expense. So, what is the amount that the entity would eventually get by completing the transaction is the transaction price. As I said, mathematically, it is read as invoice price plus or minus variable consideration is called transaction price. As I said, most important thing, remove from the minds or remove from the perception that variable consideration is something that is only going to reduce your invoice price. It is like standard deviation. It has the propensity to move your number either ways, like a simple pendulum. It does not mean that it is only southwards. It can go northwards as well. It can increase your compensation if you have performance bonus associated with the contract. So anything. So even my day one revenue can include a component of future bonus that I am going to get at the end of the period. But what is the recognition criteria? What is the pre-exit condition that has been suggested by the accounting standard to recognize variable consideration? There is no confusion or there is no challenge with respect to identification of transaction price or the invoice price. That is the stated contractual price in the agreement. That plus variable consideration. What do you mean by variable consideration? All the credits, discounts, bonuses, defects, considerations paid back to customer, whatever may be the manner, where there is a high probability, I repeat, where there is a high probability that the money would be either paid by the seller or will be received by the seller, because it's unidirectional. It is bidirectional. Basically, it can go either ways. What is the high? If it has a high probability that this particular discount will be offered by me, I will consider the discount as a variable consideration. If I have a high probability that this bonus will be received by me, now here who is me? Me is the seller. From a seller's point of view, I am computing the consideration to match against the 6 performance obligations that are identified from the 10 promises. 1 lakh rupees plus or minus some variable consideration. What is the highly probable amount that I will end up getting as a bonus, or what is a highly probable amount that I will end up making payment as a discount? I will forego or I will receive extra. Let's assume in our example, I am entitled to some extra bonus of 20,000 rupees. So let's take the example, 1 lakh plus 20,000 is my total transaction price. 1,20,000 is the transaction price for 6 performance obligations. I repeat, a bonus that comes to me at the end of the period, if based on my past performance and the performance so far done, if I believe it is highly probable that I will get the bonus at the end of the period, I will start recognizing revenue even for the bonus amount. So first and foremost, remove from your minds, Ind As 115 is a standard that prohibits revenue recognition. No, Ind As 115 encourages recognition of revenue, but of course, under the aegis of some recognition and measurement concepts and constraints. So a constraint has been introduced by the accounting standard saying that what is the litmus test that I need to establish? Is there a high probability, not normal probability? Then what do you mean by high probability? Not defined. Generally, the Big Four guidance is anything should be more than 80 and 85% is only can be considered as high probability. So if it is an 85% probability that you will get the bonus of 20,000, you will include the 20,000. So one point for you to consider, if you have not yet evaluated from this angle, if there are profit share arrangements in your contract, in any of the contracts with customer, and you have a legacy of collecting profit shares, make sure that your revenue recognition number gets changed using the principles of variable consideration. But as I said, you need to establish that there is a high probability that the money would be collected. Now, how did I arrive at the 20,000? In our example, 1 lakh plus 20,000 is the high probability that I will receive the money. So Should I receive whatever the bonus amount that is there as my bonus, or should I do any approximations or multiplications with probability? Should I do anything of that sort? The same approach what the accounting standard 37 takes, even Ind As 115 also takes the same view. There are two ways of identifying a variable consideration amount. Either it is the most likely outcome approach or it is the expected outcome approach. Say for example, I will get either X or Y amount as bonus. Then take either X or Y. Then there is a most likely amount, basically means I will get from a range of probabilities what is the most likely amount that I would get. Then in such circumstances you would multiply the amount with the probability that I would get, and in another case I will get either binary position, either 0 or 1, or either 1 or 2, either 2 or 3 is the bonus that I would get. So the same principles of measuring the outcome of a provision under Ind As 37 are used even here under Ind As 115 to identify the outcome of variable consideration under Ind As 115. So if there is a bonus provision or if there is a discount provision, what is the point that I need to use? If there is a range of probabilities, what is the highest probability that you would get? If there is no range of probability that I will, or the position is I will only give you either X or Y, what is the most likely outcome? Whether I will get X or Y kind of a thing, basically. I think I am expected value approach, most likely outcome, not expected outcome approach. I've been using wrongly the word expected value approach when the range of probabilities are there. Most likely outcome, and the outcome is binary. Either I will get X or Y. So let me give you this example, then probably you will be able to understand. See this particular example. Entity A provides a transportation service to theme park customers for a fixed fee of 400,000. So he is a transporter. He offers transportation services to theme park, similar to our cab services in Nehru Zoological Park in Hyderabad. So let's assume that the annual value of the contract is 400,000. Its performance may yield a bonus of 0 to 600,000. So there is a range of probability for the bonus the transporter can get, depending on the float or depending on the footfall of the consumers, or depending on the footfall of the patrons that visit that particular national park or theme park. I will get discount ranging from 0 to 600,000. Now the question is, what is the value of variable consideration in such case? And has given you for various outcomes what is the probability that you would get. For 0 bonus amount you have 30% probability. For 200,000 you have 30% probability. For 400,000 you have 35% probability. For 600,000 you have 5% probability. Easy. 0 into 30, 200 plus 200 into 30, 400 into 35, 600 into 5. 60,000, 1,40,000, 30,000. 2,30,000 is the most expected value approach. So using same IAS 37 or Ind As 115, the expected value approach is multiplying the probability with the percentage of probability, and I get 2,30,000. So my revenue is, for the purpose of recognition, 400,000 plus 2,30,000. Again, the 2,30,000 or 2 lakhs or 3 lakhs is going to get by the person only by the end of the year. Don't think that this is contingent revenue and this cannot be recognized or not earned. The earning activity is the same thing. I need not do anything extra to get that extra amount of 2,30,000. It is my day-to-day activity done with some additional efficiency will give me that 2,30,000 rupees extra. So the accounting standard says even the bonus can be recognized and can be considered on day one for the purpose of recognition. So assuming an over the period recognition, 6,30,000 will be recognized over the 12 months period. Always adjusted to the 2,30,000 will always be adjusted to every reporting date, depending on my performance and based on my probabilities. I will recheck on the amount that I have computed at every balance sheet date, so that I will come to the most close number when it comes to buying performance bonus by the end of the period. Now, would the answer be different? What is there in that box? Would the answer be different if the bonus amount can only be one of the amounts but not a range? So, means either I will give you 200,000, or I will give you 400,000, or I will give you 600,000, or I will give you 0. But there is nothing called 2,30,000 in between. So there is no range of 0 to 600. There are only 4 possible numbers. Then what I would do is, what is the highest percentage of possibility of getting some amount of money? Read it in an inverse way whenever you have the percentages. There is 5% probability for 600,000. Definitely not highly probable. That is not called highly probable. There is 40% probability for 400,000. If I get 5% for 6,000 means there is 5% chance for 400,000 also, no? So the 5% of probability gets added. Same permutations and combinations, theory of probabilities in our school. I will add the probability. 35% plus 5, 40% for 400,000. Even 40% is not highly probable. It did not even meet the probability criterion. Plus 30% if I were to go for 200,000. What is the probability for 200,000? It is not 30. Independently it is 30. But I will have 70% probability if it were to be the only outcome. So 70% for 200,000 to an extent. In this example, while the answer is not given, I would say probably, yeah, you can say that it is highly probable that 200,000 can be considered by an entity for the purpose of recognition of variable consideration. So it is not the list price, or it is not the invoice price, it is not the stated contract price. It is all these amounts plus or minus variable consideration. What is variable consideration? Any discounts, refunds, or monies that I will get or I will pay, which have the high probability that it would get ended up as settled. That means either I will get it or I will pay so much amount of money by the end of the period. If I have high probability, then I will consider that amount. How do I measure the number? Using the same approach that is there in Ind As 37. Expected value approach, if there is a range of probabilities, or most likely approach, if either of one probability is there but not all. Next. Right of returns. Yeah, now now we are done with that variable consideration. Now we will touch base on some of the practical points. Right of return, the concept is explained in step 2. Measurement of the amount is explained in step 3. I have already covered both, so I'm just jumping the gun. See the same example what I have considered here. 9,700 for 10,000 revenue, 300 rupees of refund liability, 180 rupees of reversal of cost. In fact, I have taken the same numbers while explaining that particular example. Next, one exception to sale, variable consideration. Like how there is an exception to distinct nature of performance obligations for services that are highly integrated, highly dependent and highly related, and significant modification needed. There is an exception to variable consideration. What do you mean by exception to variable consideration? Meaning, this kind of a future income. What is this kind of, which I am going to explain now. This kind of a future income, how much high it is probable as, even if it is highly probable, it is not considered for the purpose of variable consideration. What is that nature of income? In case of a license of intellectual property, sales-based royalties, usage-based royalties. That means for every unit sold, say for example, I am the author of a book, let's say accounting book. Fortunately or unfortunately, let's assume that got published. And so many number of units got sold. If I have transferred that license to somebody, and I said I will get some upfront amount, and I will also get some usage-based royalty based on the sales made. I will have so much amount of money to me. So it is a sales-based royalty on the license of an intellectual property because I have written a book. The standard says, even though in the past you have established a high probability that at least these many number of units will be sold, but these many and this much amount of money you have collected in the past, you will not recognize that royalty amount. Means if the same example were to be taken, that bonus of 2,30,000 for the theme park and 200,000 for the theme park as the case may be, if it were to be an out licensing of intellectual property, is not considered as variable consideration, meaning I will stay put with revenue of 400,000 only, and I will start recognizing 230 or 200,000 as and when the units are sold and collected by me. Let's not get into, as of now, given the paucity of time, logic behind company, standard having this kind of exception. Let's stay put with a prescription model, and there is a sales-based, usage-based royalty amount, which cannot be considered as variable consideration, how much ever high the probability may be with respect to collectability. Significant financing component. Whenever there are any transactions that have significant financing component, meaning where the collectability pattern does not coincide with the economics of the transaction which have previously dealt with. Now, I have seen in my experience many people asking me one doubt: if different customers have different credit terms, does that mean significant financing component? No. In fact, not all customers should have same credit term. Credit term has to be different based on the credit worthiness of different customers. But when a particular transaction will become transaction of significant financing component, say for example, there is a customer A to whom I generally render or offer 90 days of credit period for a volume of say 1 crore or 1.5 crores in a year. Say for example, in a particular transaction in the month of March, where the transaction is to the tune of another 1 CR and the credit period is 360 days or say 180 days. Double the credit period that has been so normally offered to the customer. That poses a question to you whether this particular transaction is basically a transaction involving a dumping kind of a scenario, so that a financing element is involved here, so that it can be facilitated by the vendor to the customer, that because as and when you sell it, I can give you can have the collection and I can receive the money. So these kind of position, whenever a significant financing element is there or you perceive it must have been there, it leads to one more evaluation. See whether there is a collectability issue or not first. If there is a collectability issue, again it goes back to, is there any implied price concession, or is there any statement by the company that I am not going to collect the money, or is the sale conditional upon him selling the product further? So a significant financing transaction theoretically can be an isolated concept, but practically when you face this transaction, please rule out other probabilities, that is this by any chance a conditional sale, because he cannot afford to purchase 1 crore worth of goods in March. Is it by any way a push-up transaction by the entity that please take this inventory and you can pay me leisurely as and when you sell the product, meaning it's a conditional sale, so no revenue is recognized. Or I have given you a significant financing element where portion B is recognized as an interest. Or is it something in the form of of course that's a governance aspect, I don't want to get into it. Yeah, so please rule out the other possibilities that might be hiding their face in the behind the significant financing component. And whenever there is a significant financing component, what is the percentage that needs to be used? Incremental borrowing rate. Obviously you won't get the IRR implicit in the contract, so basically it's preferred to take incremental borrowing rate. Non-cash consideration, same example. If it is not cash, the fair value of money or money's worth I am going to get will be recognized. If it can be measured under any other accounting standard, say for example financial instrument, I will take first the cognizance under Ind As 109. What is the investment value that I will have to recognize? Then I will recognize so much amount for revenue. I will attribute so much amount for revenue. Recognition principles will follow. Now, consideration paid or payable to customer. Very, very subtly explained. In fact, very, very elaborately explained in US GAAP. The reason why I said there is a convergence project is because both US GAAP standard setters and IFRS standard setters have come together and written this accounting standard. Many items or many principles that were already existing in US GAAP, where US GAAP has elaborate literature, have been now brought to IFRS as well. This concept is beautifully explained in US GAAP. Those who wanted to read, you can actually refer to US GAAP literature. It's not that elaborately explained in IFRS, but the principles remain the concept. Generally, consideration flows from customer to seller. Sometimes after the transaction or as part of the transaction, I might have to pay, in the sense the seller might have to pay consideration back to the vendor, consideration back to the customer, depending on various parameters. You call it defects or you call it discounts or whatever may be. Or because I have obtained another service from the customer, I might have to pay the same consideration back to a portion of the consideration back to him. What are the principles of money that is paid by the entity to the customer back or payable by the entity to the customer back presented in the financial statements? The fundamental presumption is it is always an adjustment to the purchase price of the product, meaning sale price of the product, meaning the first and foremost presumption by the standard, I repeat, the first and foremost rebuttable presumption by the standard is it is an adjustment to the sale price. So whenever there is any flow of consideration back by the vendor to the customer, your first answer is it has to be reduced from revenue. Okay. Are there any exceptions to it? Yes, there are exceptions to it, provided two conditions, both the conditions are satisfied. The company can show the amount not as a reduction from revenue, but as an additional expense or whatever it is, additional payment to the customer. What are those two conditions that must be satisfied? One, the customer is rendering separate service from the original sale transaction and the service is at the fair value. Meaning, seller is offering some service to customer. At the same time, customer is also rendering some service to customer, no way linked to the original sale transaction. So the separability of the service that the customer is offering to the seller is very much important to say that these two are separate. Why to complicate with so much of language? I'll give you an example. The example which I have practically learned when I'm learning the concept, when I was with KPMG. KPMG does the audit of Wipro, and Wipro offers the software maintenance services to KPMG. Is there any link to these two services? Absolutely no. One is an advisory and accounting service, another one is software service. So one service is clearly separate from the original transaction. So whatever the audit fee KPMG earns from Wipro is its revenue. Whatever Wipro charges KPMG for software related services is its revenue. Both are grossed up. They both are not netted. Why did I take this kind of an extreme example? Always keep in mind, this is such a slippery ground. You need to have this much amount of crystal clarity in establishing one is different from another service. Now I will introduce you some of the slippery points. What are they? Cooperative advertising contract. The customer said that I will offer you advertising services because you are selling me at 20 rupees and I am offering you advertising services, let's reduce 2 rupees from whatever I am paying to you. You pay me 2 rupees for advertising service, I will pay you 20. Now, the contract is like this. Can you enter into, okay, because I entered into an advertising service and I entered into a purchasing contract from a customer point of view, the first and foremost point is on the face of the contract, it appears that anybody can offer the advertising services, but you have entered only with the customer. But the litmus test to be put forward by the entity is paraphrase the same question again and again. Can the cooperative advertising services be offered by anybody else other than your customer? Can you enter into any contract of cooperative advertising other than from your customer? Answer is no. If the answer is, even though it is a separate service, if you cannot enter into that contract with anybody other than your customer, it is something related to your sales contract. You can't identify harsh position. It is related to sales contract. So your establishment of separation is beyond doubt. Even if it is doubt, or if you can't separate, it is reduction from revenue. To what extent it can be reduced from revenue? You will be surprised. Say for example, in 1 year, I got 100 rupees as revenue, and in another year, I did not sell anything to that customer, but I paid 20 rupees back to that customer. You won't believe, at a customer level, you will show 20 rupees negative revenue. The concept of negative revenue existed in United States GAAP, but IFRS nor Ind As were explicit about it. So if companies have this kind of a position, they need to draft their own accounting policy of deciding what will happen to that extra deficit if there are no sales in the period. Meaning, in a hypothetical scenario, if my sales at a company level are zero, hypothetical scenario, zero, but I paid something back from the past customer for the past period in the current year, you might end up, depending on your accounting policy choice, showing a negative revenue. That's harsh this accounting standard is. Very easier examples I can give you is slotting fee. What do you mean by slotting fee? You go to Ratnadeep, or you go to Vijayata, or you go to any other grocery store. You will find the dairy milks exactly at a particular point where the billing will be done, right? All the mouth fresheners, dairy milk, chocolates, whatever the kids will try and actually trying to buy, everything will be there, will be found there on. That's called slotting fee. So dairy milk, Cadbury's is selling the product. Cadbury's is paying money for putting his product in a particular slot. You can't separate. I can't have the product displayed in Ratnadeep and I can't have a slotting agreement with another customer. I can't have it with Vijayata. Obviously no. So obviously, is it a contract that can only be entered into with your customer? How much ever value, fair that particular value is, if it is something that can be entered into only with your customer, you are doomed. Meaning your revenue is negative. Sorry, it has to be a reduction from revenue. So don't even think of it. It has to be a reduction of revenue. Don't think that it is a separate service. Pepsi sells the product, but at the same point in time says that all these danglers, now Amir Khan, Katrina Kaif, Kareena Kapoor, all these danglers, for displaying them in a particular locality, I am paying you advertising cost. Now you can't enter into a dangler arrangement with anybody other than your customer. So don't say that it is an advertising service. Don't say that it is a slotting service. It is with the same customer to whom you have sold. It is reduction of revenue, chop off the head of revenue. That's it, as simple as that. Harsh position, that's okay. Now, allocate the transaction price to performance obligations. Let's continue with our example. I think I might have to bust out on the time. I will take another 20 minutes or so to complete. I'll try to wrap it up as fast as possible. So step 4, allocate the transaction price to the performance obligation. I'll stay here only in this particular slide and I'll explain the whole concept. Going back to our example, you have a contract, you have identified 10 promises, 6 performance obligations, 1 lakh rupees plus 20,000. 1,20,000 is the total transaction price. Now see, you have reached a position, 1,20,000 is for 6 performance obligation. Now the standard is asking, allocate the transaction price to these 6 performance obligation. How to do? 1,20,000 divided by 6. No. It says in a particular methodology has to be followed. What is that methodology? The first and foremost step is these 6 items first identify in proportion to their standalone selling prices. What they mean by standalone selling prices? Are you dealing with these products independently also? Yes, I am dealing with these 6 performance obligations independently. What is the independent selling price for all those? Say for example, 2:3:4:5:6. In the ratio of 2:3:4:5:6, allocate 1,20,000. So the first and foremost requirement of allocating the purchase consideration is the allocation of single amount of purchase consideration has to be done against or using the proportionate fair values which are standalone selling prices of each performance obligation. No, sir, I don't deal with these 6 products or not all the 6 products independently. Only 1 or 2 are dealt with, remaining 4 are not dealt with or not sold by me in the market. No problem. Estimate the standalone selling price. So you can't do away with accounting based on the standalone selling price. Either it must be on its own. If it is not on its own, you don't have the history of selling them on their own. You have to estimate it. How do I estimate a standalone selling price? If not you, somebody else will be selling in the market. So the first approach is adjusted market approach for identifying a price. If not available, there is some cost that you know, cost plus expected margin approach. Generally, certain industries operate in some agreed margins. Say, for example, 10% to 15% margins in construction industry. Not exactly, not that I know that so much amount of percentage. So, and in pharmaceutical service industries, 30% is the margin levels. Or in case of supply of a particular product, 20-25% is the margin level. So when you know the accepted margin levels and you know what is the cost, either you can take out independent selling price of that product offered by another party, or if that is also not available, you can identify your costs plus what is the margin that is generally there in the market for that product. You will identify some standalone selling price. After identifying 2 are independently sold, 3 are estimated, 1 is left over. Answer is residual approach. 1,20,000 minus whatever the rest on value will give you whatever that residual value approach. In that proportion, you allocate 1,20,000. Now, let me just. As I said, I will skip all the examples that have been given. Yeah, that's very important thing. Allocating the discount. You allocated the invoice price, variable consideration, but here, but the standard here explains you one particular, specifically one methodology for discount. What it says is, say for example, I'll give you an example, nowhere near. Say very commonly used. Let's say there is a company that deals with shampoo, conditioner, and shower gel. Say 120, 130, 150. This is the price. Total is 400. But if you buy them together, you will get it at 300. So the discount is 100. For that company, shampoo sells much better. Conditioner sells the worst. So they have a package of conditioner and shampoo as well, which I said 120 plus 150, 270. But the selling price is 170. Now, how should the discount of 100 be treated in the books of account? What it says, what the accounting standard says is, identify, is there any combination in the existing set of performance obligations that is sold separately at discount? Yes, shampoo and conditioner are also sold at discount. At what value? 100 or say 90. So the discount of a package is substantially equivalent to the discount that is offered now. So what it says is only shampoo and conditioner should have that 100 rupees discounted allocated, not shower gel should have any percentage of 100 that should be allocated to. So when shampoo is sold, it is not exactly at 120 is to 130 is to 250 when I told you this percentage. It is not exactly 120 into 400 divided by 270. It's not, sorry, 270 divided by 400. It will have some amount of discount. But when shower gel is sold, it will not have any amount of discount. It is, and again when the conditioner is sold, it will have some amount of discount. What is it trying to say? It says only one thing. Other things remaining constant, normally discount also allocated in the ratio of standalone selling prices. But if you identify that there is some element of discount that has to be exclusively go to one particular performance obligation, because that performance obligation generally gets sold at discount in the world, you might have to evaluate whether that pertains to the same, whether should that be allocated only to it. And the litmus test to it is how in general, apart from this contract, and at what value that particular amount of discount is being offered in it. If the discount is substantially equal, the standard uses the word substantially equal, then you have to offer the entire amount of discount to one performance obligation. If it is not substantially equal, normal principle in proportion to their consideration. Same is the principle for variable consideration also. Because in a series of steps, some steps are in some industries are extremely complex. They are result driven. If you can do it by a specified time, I'll give you 10 lakh rupees of bonus. Don't think that entire 10 lakhs has to be allocated to all performance obligations. You might have to evaluate whether that bonus is applicable only to one performance obligation. Clear? So you have identified a contract, you have identified an agreement with the customer, evaluated the agreement with contract, identified 10 promises, 6 performance obligations, 1,20,000 rupees of purchase consideration, allocated using their respective values. You have allocated the variable consideration of 20 also to specific matters. Now the fifth one, last step, recognize the revenue as the performance obligation is completed or when the performance obligation is completed. So I will go to fifth point. See here, recognize the revenue when the entity satisfies the performance obligation. PO is not purchase order, performance obligation. Or as the entity satisfies the performance obligation. What do you mean by when the entity satisfies the performance obligation? Meaning at the end of the period. What do you mean by recognize revenue as the entity satisfies performance obligation? Meaning over the period of performing the obligation. What for the guidance or for which methodology the guidance is given? The guidance is given for transactions or for instances where over the period revenue has to be recognized. So now I identified 1,20,000 and in that I have bifurcated for, say, for example, for performance obligation 1, it is 20,000 rupees. Let's say in our example. Now, should I recognize revenue as I am performing the obligation 1 or only when once I complete the obligation? For that, the guidance is accounting standard says when the company is eligible to allocate revenue over the period. It has given guidance for that only. If that guidance is not met, there is no second part. Revenue is recognized only at the end. What is that guidance? More or less similar to whatever that we have, the portion which I have discussed earlier. It says either of the 3 conditions must be there to say either of the 3. It's not all the 3 or it's any of, it's any of the 3 conditions must be satisfied in order for an entity to recognize the revenue over the period. What is the first one? As and when the vendor is rendering service, customer is realizing the benefit simultaneously. It happens in service industries. One invoice processed is one invoice processed for me. One floor cleaned is one floor cleaned for you. One unit of petrol delivered is one unit of petrol received by me, and everything. So utilities and service sector basically sees these kind of simultaneous and symmetric and reciprocating benefit offering and benefit receipt. If that is the case, recognize it over the period. That's why an invoice processing entity, even though each invoice is one performance obligation, going by the series concept, recognizes the revenue over the period. Second, it is performed over a period, but as and when the asset is created or as and when the service is done, an asset gets created and the asset gets controlled by the customer. Let's take an example to understand it better. Construction industry or the infrastructure industry. A half-finished bridge is half-finished. You will not start reconstructing the entire bridge again from the beginning if the construction has stopped in the middle. So when the vendor is rendering the service, an asset gets created and that asset is controlled by the customer. So I am building a bridge, I am constructing a bridge, and as and when I am building the bridge is under the control of the customer. That's the reason why construction entities or real estate entities recognize revenue over the period, because for them this condition satisfies. Third one, little peculiar point. There is no alternative use even to the entity or to the customer for whatever the item that has been done so far, but there is a right of collectability of the money for the completed work. What do you mean by there is no alternative use for the entity that has done it? I can take from the industry which I have come from, pharmaceutical industry. Sir, this injection or this vaccine is 90% complete, sir. Does it make any sense either for the customer or for the vendor? It does not make any sense. 90% complete injection does not mean I can take a 90% amount of money that is recoverable. It is not done. It is not yet completely tested. So it does not create any value either to customer or to the vendor. But clearly contract establishes a right of collectability for the 90% work done. And in such circumstances, whenever there is any service that has been done with respect to this testing service or whatever that development service, to the extent of work completed, I will give you or I will compensate you for the money paid. Here what the accounting standard says is, especially for the third one, also take into consideration the termination conditions. If upon termination of the contract for the completed work, if the seller can get the money, it is as good as right of payment is there for the completed activity. If either of these three conditions are there, I can recognize the revenue over the period. Fine. How do you recognize it over the period? Either I take the output approach, which is nothing but market surveyors method or work certified model, or input approach, which takes into cognizance the percentage of expenses divided by total expenses as a base for the purpose of recognizing the revenue. If either of the conditions is not met, it means revenue has to be recognized after the completion of performance obligation. Meaning in our example, the 20,000, if either of the three conditions is met, I will recognize it over the period of performance obligation 1. If not, I will recognize it at the end of the period. This is what is, in a way, the entire 5-step model is. In addition to that, just give me 5 more minutes. I will cover certain practical concepts which I just wanted to cover. Okay, I am exercising some veto here. I am not covering modifications now because modifications will take some time. You can read. I believe that obviously as readers, you will be able to get that. Rather than that, I will explain the other practical concepts. First, I'll max to max take another 5 to 10 minutes kind of a thing. A concept called license of intellectual property. If you see, it is not exactly equivalent to license fee. Just a second. Sorry. Okay. leave it. You might see some vibration sound. That's my mobile phone. It's okay. I'll keep it like that. Okay. Now, what is the guidance with respect to license of intellectual property? This kind of a guidance was not existing previously under Ind As 18 or Ind As 11. The guidance has been newly incorporated, and it says only one thing. The first and foremost thing, it says first one thing is transfer of license is a distinct performance obligation. So similar to whatever the principles that we have seen in step 2, distinct performance obligation, when whether a promise becomes a distinct performance obligation or not, similar principles you need to use. With the license that has been transferred to the entity, can the entity benefit on its own with other available resources? If the answer is yes, the position is that license is a distinct license, meaning now I am separating the license from the other performance obligations. The standard gives you examples predominantly of license of software and license of pharmaceutical industry coupled with other performance obligations. So what it says is license is a distinct performance obligation. Say for example, you have established that. Now for that license, should I recognize it over the period or should I recognize it immediately? The answer is it depends on what sort of license you have given to other party. So it introduces two distinct words called right of access license, right of use license. Right of access means I only have a usage privilege. I'm only an user and I will be using this particular license for the remainder of the period or the period for which the license has been taken. If it is a right of access license, you will recognize the revenue over the period. Even though it is distinct, the license fee is recognized over the period. If it is right of use license, meaning I have given this license to you, boss. Whether you will play with it, whether you will kill it, whether you will develop it, whether you will sell it, I leave it to you. So you can control the license more than I do. It's analogous to sale of IP. In US GAAP language, it is called functional IP, functional license. I can deal with the license in the whims and fancy of my own nature, basically. Then I will recognize the revenue for license fee at a point in time. So there can be a license which is right of access. There can be a license which is a right of use license. Don't get mixed up with this right of use with right of use of asset. In case of leases which is over the period. Here right of use is point in time. I'll recognize it now itself. Because I sold the license to you, you are free to do whatever you want to do with that license, or I am not needed for whatever the decision making you do with that particular license. You exploit it, you explore it, you kill it, I leave it to you, whatever you want to do. Then I will recognize the revenue immediately. No, Baba, it is our only usage license. You have to use it for the next 3 years and you have to give it back to me. The license fee is recognized over a period of time. Be very careful, especially if you are in a pharmaceutical industry or in a software industry with respect to this. Repurchase agreements, anything sold with call option, with put option for the buyer, nothing gets recognized as revenue. Options also, these are only rights but not obligations. No, clear, no for revenue recognition. Call option is right of purchase by the seller. So call option will be for the seller. Put option, right to sell for the buyer. So put option for the buyer, call option for the seller, or vice versa, whatever it is, any options of repurchasing, no question of recognizing revenue, recognizing revenue. Why? You can correlate it back. The guidance is available in IAS 32, Ind As 32, Financial Instruments, Presentation and Disclosure More, paragraphs 19, 20, 25. If you read those paragraphs, you will be better able to correlate why these options become liabilities and the money really, received is not revenue but rather a liability. Why that becomes liability, you will better understand when you read those paragraphs. That's the reason why in the scope paragraph, he said any contract for which financial instruments accounting standard is applicable is ruled out from Ind As 115 standard. Bill and hold. Guidance has been brought little more differently, while the principles to an extent predominantly remain the same. I mean, the reason for bill and hold has to be substantive. Why the customer is opting not to take the delivery and why he has asked you to basically hold the product on his behalf. One point that was removed from earlier guidance is normal payment terms apply. For some reason, they decided to say that, okay, you need not explain very clearly in the contract what about the payment terms. But the interesting component with respect to recognition of revenue in bill and hold is, in case of bill and hold, there are two performance obligations. One, for the supply of good, where I have completed my performance obligations and I am ready to deliver the product. Then the customer said, hold on, please keep the stock on my behalf with you. So for the remainder of the period, I am only a custodian. So the custodian value has to be carved out and has to be recognized over the period. Say the total value of the consignment is 1 lakh. You might have to end up based on the warehousing services that locality charges for 3 or 4 months period. Say that holding period is 3 or 4 months. Say for example, 2,000 is the warehousing charges. 98,000 will be recognized immediately. 2,000 represents the revenue for custodian services will be recognized over the period for which you are holding the inventory. Contract costs, not just the revenue component has been dealt with in the standard, it also reasonably explains the costs associated with execution of revenue, costs associated with acquisition of revenue contract. So it bifurcates the total costs as costs to obtain the contract, costs to execute the contract. Obtain the contract, more or less similar to directly attributable costs in under IAS 2, under IAS 16 and under IAS 38. Cost of acquiring an asset. Similarly, directly anything commission that is payable to the agent that have given me this contract, or legal fee that is paid for purchasing this particular contract from anybody. All these directly attributable costs can be called as costs of acquiring the contract. They can be put on balance sheet and amortized over the period for which the contract is executed. Next one is costs to execute the contract. These are nothing but the costs of revenue. Whenever there is any big contract, so these are not for selling medicines and not for selling apparel or watches or whatever it is. These are meant for, say for example, think bigger examples like sale of an aircraft, sale of software. No, this 2G 3G licenses kind of a thing, where I have to first build this license, develop the license, purchase many associated contracts, then I will execute over a period of time, then I will sell the 3G license or 4G license to you. It's a big time, big contracts basically. At that point in time, costs of obtaining the contract, I will recognize it over the period. Costs of executing the contract, which are meant for the contract, as and when they are incurred, they are charged off to P&L. Disclosures, yeah, I have given the Excel sheet. Elaborate disclosures have to be given. So given the paucity, I'll just probably ask you to take it on your own. That's it from my side. Now if you have energy, I'm okay to pick up any question that the audience has.
So there is like no questions from audience end actually. If any questions raised by audience, they will be mailing us out, sir, actually.
There are?
They will be like mailing us out, sir.
Okay, no problem. I am free to answer them.
Like, yes, as of now it is like 8:05, so we'll like.
Yeah. I know I have busted out on time. I am very much reputed for this kind of a thing.
Yes, sir.
Thanks a lot. Thanks a lot for the opportunity. Thanks a lot for the patient hearing so far.
Yes, sir. In the absence of our chairman and secretary, I would like to thank you on the behalf of them, sir. Thank you so much for taking in depth of knowledge with all the think the examples as you gave for the members, it would have like really enlightened them. So thank you so much for your time, sir.
Thank you. Thanks a lot.
Yes.
Thanks a lot. We'll be more than happy to take up these kind of things in future. Thank you.
Definitely, sir. Thank you so much, sir.
Thank you.